The team there have been saying is that, yes, wages will be going up. They're seeing about 5% wage increase in France, but that's going to be offset by the softness, the drop in pricing around some of their inputs, around some of their raw materials going in. And as you rightly say, doesn't see a big risk around Red Sea disruption, at least at this point for Michelin.
I mean, it's something that's going to be, we're again watching very, very closely. It's not the only company that we're monitoring here. Of course, the markets are now open right here in the UK and over in Europe. FTSE 100 virtually unchanged right now, 75, 71, we'll call it, on that print. Marginally lowered though, but we'll see if it kind of recovers as we get some of the other prints on some of these stocks as well. But again, to your point, it's all about the margin story for wages, for services inflation, but also we're trying to wait for a print on UK gilts as well. I'm curious how much of the jobs numbers that we got about an hour ago has an effect on the stock market.
So gilts are trading right now, currently 456 at the front end, yields up between 1 to 3 basis points across the curve here in the UK. The 10-year here in the UK, 4.09, and back above that 4% level, yields up just 3 basis points. So it's not dramatic, but there is a little bit of selling pressure coming across the UK debt markets. It's worth also thinking about in terms of the equity story here in the UK, as well as what's happening with wage data. The commodity story is also standing out for me today. Iron ore is a little softer, but copper is up 0.7%. Oil is up as well, so we'll see how that's playing into the mining sector of the UK. FTSE 100 posting those gains so far of about 0.1% across a European benchmark, then downside of 0.2%. We are, of course, in a bit of a waiting pattern ahead of that CPI print out of the UK. On a sector-by-sector basis, it was real estate that was at the top of the list for you yesterday, Critty, with gains there coming in quite pronounced across the real estate sector. Technology was actually one of the weaker performers in the session yesterday, and technology right now is currently down about 2.8% across your sectors. Basic resources, as I suspected, as a result of what's seeing in copper and oil, basic resources up 0.7%.
Yeah, let's talk a little bit about some of the biggest movers that we're already seeing. Again, we're still waiting for some of the pricing to shake out. It is early days, but ASML is dropping right out of the gates. In terms of trade gate pricing that we saw earlier in I don't want to say pre-market, but pre-market was down about 2% as well. It's unclear what the motivation here is, but it has been noticeable that you've seen SAP and ASML actually be the leaders in the last couple of days. You don't really need a fundamental reason for that stock to crumble as we're talking about some of the pressures on the technology space as a whole. Right now, it is dropping about 7%, and again, followed right on its heels by SAP.
Well, it also is a reminder that just because one tech stock with links to AI is doing well doesn't mean that you buy the broader sector, because, of course, ARM storming ahead with further gains yesterday, $150 billion market cap now, 3 straight days of double-digit gains, almost tripling the market value of that business because of its AI play. You saw the read across to SoftBank in the Japanese session, the Nikkei T225 opening the gates, coming out very strongly after the Lunar New Year holiday in Japan, but you're not seeing the read across in terms of the strength that we saw in the semiconductor makers in Japan to what is happening in Europe so far, at least. BE Semiconductor is also down about 2.6%, but as you say, the standout really is the ultralithography machine maker ASML, of course, listed over in the Netherlands, currently down 7%, Critty.
I'm sorry, say that 5 times fast.
Ultralithography. Ultralithography. There we go.
There you go. He's got it. I can't say that, but
ultraviolet lithography.
I'm just going to say a chip making machine. Keep it simple there. Again, it's an interesting dynamic. I want to get a quick check on the Stock 600 as well, because when you talk about kind of where the regional leadership is there as well, one of the themes that we've been talking about is the luxury space and how the French stocks have actually been outperforming in a really big way. But right now, when you are again looking at the index weight on the Stock 600 as a whole, it comes right back down, as you mentioned, to the tech space. You're not even seeing the leadership, or I should say the decline in healthcare stocks traditionally, I've noticed that the tech stocks and the healthcare stocks have kind of moved in tandem. This morning, healthcare actually leading on the Stock 600 in terms of being an index contributor. Novo Nordisk, your AstraZenecas, your GSKs, they're actually outperforming some of the commodity names.
Yeah, auto's doing well. Basic resources top of the list. Auto is also posting gains of around 0.3%. And as you say, some of those safe haven tilts, or at least more defensive tilts around utilities and around healthcare, some of the leading gainers, but modestly up around 0.2%. But I know you're also thinking our next guest as well is going to be thinking and unpacking the granola story for us. And luxury has a place in that.
Do you know what granola stands for?
I know it's what I have for breakfast.
That's what I thought as well. So I was shocked when our previous guest last week had said it. This is, I think, the crucial story of the morning. How do you actually like your stocks? Is it magnificent or with a side of granola? And yes, I had to make that pun. Our producer wrote it. Dan Scott of Vontobel Asset Management actually told us about how he's assessing it for quality. Take a listen.
When you talk about bond markets and how people are positioned, but also equity markets, I think both are very similar in that people want safety. So they're positioned in quality. And I think that's where we have a consensus in the market. I think we all know that likely some parts of the market are going to go pear-shaped. And so in equities, we want quality. And how do we express quality? The Magnificent Seven or the granolas. Why? Because they have strong balance sheets. CAGR on the granola is what, 7%? So I guess 7% revenue growth, but a strong balance sheet. That's nice. I'd say the only problem with the Magnificent Seven is that 4 of them die, right? If you watch the film.
This is a dark take, Dan.
So was Tesla number 1? You know.
Dan Scott, the head of multi-asset at Vontobel Asset Management, giving us a side of darkness alongside some really fun acronyms. Let's get a little bit more insight here. Sharon Bell, senior strategist over at Goldman Sachs Research, joins us this morning. Before we get into the smart stuff, granolas is a new term, right? I didn't just imagine this.
Well, we came up with it a couple of years ago, during the pandemic, actually, and we picked the 11 largest companies in Europe. And it was largely because we wanted to show that the largest companies in Europe are not banks, they're not oil companies, they're not autos, they're actually tech stocks, healthcare companies, and branded consumer goods.
I mean, it's a fascinating story, but let's dive into it from a sectoral standpoint. Healthcare seems to be the outperformer. Weight loss drugs are all the rage from a fundamental standpoint, but I'm curious about getting into healthcare when it is famously a pretty risky business, especially when you're talking about biotech. It is you're either kind of win the lottery or you lose out in a really, really big way. And you've seen that time and time again until now, where even this morning you're seeing this divergence between healthcare and broader tech. How do you interpret that?
Yeah, so the ones we've got in the granolas, the biggest companies in Europe, they're big cap pharmaceutical companies. And absolutely, they do take on some risks, obviously, but they tend to develop drugs in the later stages, and they tend to have bigger pipelines, they tend to have huge R&D. And as your previous speaker said, you actually often find that these companies have really good balance sheets as well. So we don't see them as risky as the biotechs.
How do you push back against the valuation line then, the critique that the valuation is screaming stretched on some of these stocks?
Yeah, I think, I mean, something like the granolas, they trade at about a 30-40% premium, PE premium to the European market. That is a little bit expensive, but they have a lot more growth. The problem is the rest of the European market isn't growing that fast. The economy is close to flatlining the last few quarters. These companies have got global footprints and growth which is high single digit.
So to be clear, they're somewhat detached from the soggy growth picture that we're seeing in the Eurozone. So as we project out to the rest of the year, and we're looking at essentially flat growth for Europe, the granola stocks can continue to power ahead. Even as China remains a big question mark, there's stagnant growth in the Eurozone. They're detached from those economic fundamentals at this point.
I mean, we as Goldman Sachs as a house have a bit more of a rosy picture on growth, it's fair to say. But even our rosy picture on European growth is just about 0.7% GDP growth for this year for Europe. I mean, that's not huge. I do think the granolas, though, who have a global footprint, have great businesses with great margins, are investing in growth very much like the Magnificent Seven. They're investing in R&D, they're investing in growth CapEx to generate that sort of barriers to entry, that better global growth and footprint. We think they can generate that.
I'm just reading parts of your research here. 60% of the past year's gains coming from these granolas companies. You highlighted, though, it's all about margin, this magnificent margin, if I can even call it that. Although I feel like I'm mixing metaphors. When we're talking about the margin growth, though, when does that stop? These numbers ultimately, it's kind of like, I made this reference a couple of weeks ago. It's like making an A+ on your report card for years and then getting an A-, and suddenly you feel like, oh my God, you're failing. How does that work in terms of the margin growth for some of these companies? When does the party stop?
Yeah, look, companies, you often find the sort of winners of the last 10 years are rarely exactly the same winners in the next 10 years.
Sure.
The interesting thing, though, these companies, and I think coming back to this point, they have very good balance sheets in a higher interest rate environment, which we're in now. That's a brilliant asset to have. It gives you some barrier to entry because other new entrants can't easily come in and compete when they would have to build up a balance sheet at much higher risk and much higher cost. So you have already a good balance sheet. You're already using your cash on your balance sheet to invest as well in R&D and CapEx to give you that growth. So I do think these types of big cap companies with a global footprint that have a stability of margin is exactly what people are looking for in this environment.
As you made the point at the outset, this grouping does not include the energy giants of Europe.
Yeah.
Talk to us about how you're thinking about the oil producers in Europe and the valuation gap with their US peers. Do you see that valuation gap closing? Is it rational? If you were to put your money to play, would you prefer European oil majors over US oil majors at this point?
So there is a huge valuation gap between Europe and the US in nearly all sectors. But
right.
For the oil sector, for the energy sector, you're absolutely right. It's gargantuan for that particular sector. And European oil is on sort of 5 or 6 times PE, a really big discount. I don't see it closing, to be honest. I don't think it will widen any further, though. It's already very, very large. And what the oil and energy companies in Europe are doing, which I think is a sensible thing for them to do with their cash right now, is buying back shares, hugely buying back shares. You mentioned earlier in your slot that a lot of European companies are buying back shares at the moment. Absolutely. The energy majors are doing that. So I don't think they're a bad investment at all. I think that they do have a buyer. It's certainly not the ESG funds, but it's themselves via their great cash flows.
But you mentioned the buyback story. Does that then distort the picture? If you actually look at these earnings, they're not incredible earnings. They're coming in line, but they're not outperforming in any way. Does the buybacks distort the gains?
Being flattered by the buybacks.
Right.
They're probably being flattered by the buybacks. I mean, the next couple of years, we think EPS can grow for these companies, but that's largely because you're getting a smaller and smaller number of shares over time. So your EPS can grow even if your sort of headline dollar amount of income doesn't grow. Just the fact that you've been buying back shares, you've got a smaller number of shares, you can see EPS grow. And I think for companies which are slower growth, older economy companies, that makes absolute sense.
Okay, Sharon Bell, really lovely to see you in the studio. Thank you very much indeed for joining us this Tuesday morning with the view there, of course, on the granola stocks here in Europe. Further opportunity, further upside, arguably, despite the stretched valuations, or at least the view from some that maybe valuations are looking stretched. Sharon Bell, Senior Strategist at Goldman Sachs Research. Let's get a check on some of the individual stocks on the move. We have some standouts, Joe. Joe, walk us through what's popping today.
So we're going to start over in Amsterdam with ASML because somebody is having a bad morning. I'm told that there was a fat finger in ASML at the moment. Somebody pressed the wrong button. That stock dropped 7% at the open, the most since October 2022. So well over a year for that one. But coming back up now, down around 2%. Seems to have been an erroneous trade is what traders are telling me this morning. Then in terms of Siltronic in the wafer chip space, down 6% at the moment. It was down close to 10%, not as bad as some had expected, but earnings will have to be cut by around 20%, according to analysts, given weakness in that company over in Germany. So both of those shares are weaker in the tech space today. Then in terms of a couple of other of the earnings that we had in stocks to watch, we're going to take a look at Michelin. That one, a strong gain for that one, up 4%, doing a buyback, and also their pricing holding up a bit better than expected. Some weakness in the tyre space recently, so that one doing well. And another gainer is TUI. They are seeing some moderation in bookings, but at the moment that's not enough to send the stock lower. It had a really bad last year, as we said, in stocks to watch, given a capital raise, but coming up again. And then a couple here, ThyssenKrupp Nucera. This is the green steel firm, so steel that's sold into the green energy space. Strong results from them. And Randstad, that one in Amsterdam, that actually dropped at the open as well. It's recruitment, a bit of weakness there, but coming back up again. It's a sector that's been hit by warnings over the past 12 months. So positivity in all of those European earnings this morning. Then in terms of some index change news that we had after the close of trading yesterday. HelloFresh is removed from the MSCI Global Standard Indexes following a big drop in that stock. And the same is true for Wacker Chemie, a chemicals company in Germany. Both of these firms have had a rough 12 months, so they lose their places in the MSCI indexes, meaning fewer passive funds will be buying shares, and those stocks are coming down at the open of trading today. Then we've got your morning calls, a big one from GlaxoSmithKline. They recommend buying the stock. This is over at Citi. Citi recommends buying GlaxoSmithKline for the first time in 7 years. GSK has a new bone cancer drug, and Citi says that's the reason you should be buying that one. So that one is coming up slightly, around 0.6%. Price target of 2,100, some clear upside for that one. And then on the downside, we've got Equinor. This one has a price target cut and an underperform rating over at Jefferies. 16 analysts have sell ratings on that stock, probably one of the highest in Europe. Weakness in the gas market for the Norwegian firm, so that is a weak one today. As I say, underperform at Jefferies and down 1% over in Oslo.
All right, Joe Easton from our equities team, we thank you so much. My head is still spinning from that fat finger trade on ASML. You are seeing it move, contributing to a 36% decline, I should say, in the index, in terms of index contribution on the decline of the actual index itself, but still down 2.2%, Tom. That's a mistake I wouldn't want to make.
Yeah, you would not want to be sitting in that seat right now, would you, given the drop of 7% right at the start of the session. Before, of course, it was temporarily paused for the volatility. Now down, as you say, a little over 2%. So we'll see if there's any more that comes through on that ASML story. Broadly across the European space, of course, you are currently seeing losses of around 0.2% on the stock 600.
Yeah, but still some pockets of positivity there. One of your biggest index contributors to the upside is actually Michelin here. So again, some of the earnings picture is coming through. But Michelin feels like a unicorn almost in the earnings space that we see in terms of the outperformance in the earnings, but then in the share price as well. I wonder if that sticks with some of the other companies that are reporting later this week. That is your equities picture. Coming up on the program, we switch to the bond picture. Gilt yields open higher after UK wage data comes in hotter than expected. Just adds pressure to the Bank of England to keep rates higher for longer. We're going to dive into the details next. Stick with us. This is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Welcome back. Happy Tuesday. This is Markets Today. We are 20 minutes into the European trading day, seeing losses across the European benchmark. The STOXX 600 around 0.3%. We focus, of course, on what's happening in UK assets. Gilts selling off, yields up about 5 basis points on the 2-year, 3 basis points, close to 4 basis points on the 10-year at 4.09. The pound is also seeing a bit of strength coming through, up 0.1% at 126, and that can be tied to the stronger than expected wage data coming in at 6.2%, above the estimates of our great team at Bloomberg Economics, also above the consensus estimate as well, 6.2% for regular wage growth for the 3 months to December. What does that do in terms of the calculations for the BOE then? Let's bring in Anna Andrade then from Bloomberg Economics for the take on this. What's your assessment of the data that we've seen, the wage data? Does it move the dial? Does it derail expectations that cuts will be coming through from the BOE, even if those are fewer cuts than maybe some had expected?
Hi, good morning. So the data obviously came in hotter than we expected, and that's not a good news for the central bank. But we continue to think, I mean, for now, it won't change our view that rate cuts are coming in the spring. And I mean, there's essentially one reason for that, which is the BOE is very focused on CPI data right now, a little bit more than wage data, because wage growth, in a way, is sort of the late cycle indicator. So as long as if you have headline inflation falling, inflation expectations adjust, and that feeds through to lower pay demands. So what the BOE is really focused on, what we'll be kind of closely monitoring, is the CPI data. So for rate cuts to come in the spring, we'll need to see the CPI data essentially coming in line with what we and the BOE expects. And if it comes in line with what we expect, it will be undershooting the 2% target from spring. And once you have that, even though you have, probably slightly wage growth, slightly higher wage growth than you would like, it is very difficult not to cut rates.
Okay, so you sit on a headline basis, getting back to 2% later this year, but this week, the January data print is expected, you expect and others expect it to tick up a little bit, around 4.1%. How much of that is tied to energy? How much of it is tied to services? Why do we expect a little tick up in the CPI print, in the inflation print this week?
So there's essentially two reasons for that. On the headline, it's mostly, as you said, utility bills. There will be a new energy price cap from Ofgem that will start in January, and that will have a 5% increase in utility bills. So you'll see that tick up from 4% to 4.1%. On services, which is what the BOE is really focused on, that will mostly be base effects. So this reading will be sort of an uncomfortable one and an awkward one for the BOE, because it wants to see a CPI drop, but it will actually rise. But after we're past January, we think, if data comes in line with our forecast, that there will be a reversal to the downward trend. And I think our call for rate cuts in May is still live. It's still on the table. But I think the most important data point right now is the February CPI, because if that really, there's an upside surprise there, that's when we kind of will start to reassess whether a later move is probably more likely than a move.
So today's print, basically 50% of Andrew Bailey's worst nightmare, it seems like. Talk to us a little bit about the data dependency story, though. I think we had you on a couple of weeks ago, and you made this crucial point that the BOE can be more sensitive to one data point than its counterparts around the world. In terms of waiting for that second data point, do you think the market and economists, strategists will perhaps add a little bit more pressure to the BOE? How are they viewing it, and how is it different from some of its peers?
I think the BOE, the main difference, and I think that's the message we got at the February meeting, is that the BOE has never been comfortable with the current level of policy restrictiveness. So they were always sort of reluctant hikers, and in the February meeting, we really saw them being open to significant policy easing this year. So I think they're not comfortable with the current stance of monetary policy, and they might be willing to move a little bit before the inflation gets to 2%, falls below 2%. So that's why we're thinking that a May rate cut is likely. And the difference, I think, compared to maybe Euro area and the United States is that here in UK, we have the off-gem price cap, which essentially guarantees you a mechanical fall in inflation in April. So the price cap will be announced at the end of February. It will probably show that utility bills are set to fall by 15% in April. Yeah. So the BOE will know that. There's a little bit more certainty about that. That might give it room to act even a little bit before it sees headline inflation significantly undershooting.
Anna, 30 seconds. The BOE famously was first when it came to their QT story. Where does QT go from here?
I mean, the QT is really not the main policy tool that the BOE wants it to act in the background. It doesn't really want to, use it to signal any sort of policy stance. I think it's now really focused on interest rate cuts, and that's it.
Okay, Anna Andrade, thank you very much indeed, of course, from Bloomberg Economics. Let's bring in Sofia Horta-Acosta now for another lens and another look at some of the top UK stories, with a bit of a focus on what we've been hearing from the Governor of the Bank of England, Andrew Bailey, and his views on UK banks. What's he been saying?
So he says that, kind of responding to questions over why UK banks are priced below book and why they're so undervalued relative to stocks or similar stocks in the US. He said it has nothing to do with regulation. I actually kind of agree with him here, because it's not just the UK bank story that's, it's not just those stocks that are undervalued. If you compare the UK market generally, it tends to be trading on significantly lower multiples than the US, as do stocks in Europe. And actually, today we had news that TUI, a German tour operator that's also listed in Germany, is looking for a shareholder vote to leave the UK stock market. And that's very much kind of a long-term story. But I think his point, saying that regulation is kind of the way forward. Banks need this kind of extra capital to shield them from shocks like SVB, and we're seeing that again blow up in the US this year. He's saying that regulation since 2008 has absolutely nothing to do with these low multiples.
And you talk about stresses and you talk about regulation, and there's a story from the Financial Times around potential stress tests for some of the insurers here in the UK. Then what are the details on that?
So for me, this is one of the most complicated. If you're reporting on stocks and you're told that you have to report on reinsurers, it's one of the most complicated businesses to model. So what essentially the BOE is predicting, is planning, and this is according to the FT, is a stress test that takes this into account. What is the exposure that insurers here have to reinsurers if they struggle to make those reinsurance payments? That's likely to feed into the next stress test. And we know that these stress tests actually tend to be quite severe. They tend to model scenarios that are a lot more severe than the base case. So, I mean, this will be probably a very unlikely scenario, but we know that this is feeding into potentially the next stress test.
All right, Sofia Horta-Acosta from our Markets Today blog. We thank you so much for bringing that into context. And get more from her and the team on the front page of the Bloomberg UK website. Simply type in TLIV Go on your Bloomberg terminal. You are seeing stocks kind of mixed at the moment. We're going to dive into it after the break. But coming up, we take a closer look at Europe's farmers' protests and how agriculture become a key battleground in this election year. Tom was talking about tractors earlier. I think we're going to have a good little chat about that in just a few moments. Stick with us. This is Bloomberg.
I was around so many powerful people in my entire life, from the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time, surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. After 10 years, Joko Widodo is wrapping up a hugely popular tenure as president, and Indonesia will have its first 3-way election in 20 years. Will Indonesia continue along Jokowi's path of free and active foreign policy, or will his successor lead the country in a new direction? Keep it tuned to Bloomberg for live coverage from Jakarta and all the results and analysis you need. Indonesia decides. Coverage starts Wednesday right here on Bloomberg Television. Context changes everything.
This is Markets Today. We're about 30 minutes into the European trading. There's a couple of corporate stories that we're keeping an eye on, but net, you are seeing a little bit of negativity in the European indices. Euro Stoxx 50 down about 0.6%. The FTSE 100 marginally lower by about 0.2%, even though we did get, like I said, a couple of good earnings stories. We got Michelin, for example, which is one of your biggest index contributors, but then you have some to the downside as well. The tech story really hitting the index as a whole. We're told part of it is a fat finger trade on ASML, but they've got SAP trading in sympathy. Tech, on the other hand, I should say healthcare and biotech, on the other hand, leading a little bit higher, Tom. So that is your equity picture, but some mixed images in the bond picture as well.
Yeah, in the bond markets, the standout really, at the moment at least, is what's happening in UK gilts. And you're seeing a bit of a sell-off. Not a huge surprise, given that wage data came in slightly higher than the estimates. It came in lower than the previous month, but higher than the surveys. And so you're seeing a bit of selling pressure across the gilts curve. 5 basis point move higher at the front end at 4.6 now on the UK 2-year, and the 10-year at 4.09, close to 4.10 on the 10-year. Yields up 4 basis points. We know that markets as well, traders have been pairing their expectations around the extent of cuts likely to come through from the Bank of England, now expecting around 75 basis points of cuts by the end of this year versus at the start of the session today, pricing of around 82 basis points. 525 is the benchmark here in the UK. They're expecting traders to see that 443 by the end of the year.
Yeah, it's going to be an interesting dynamic as we talk about this into the CPI report as well, because obviously we're keeping an eye on yields, 418 on the 10-year at the moment, but the FX picture matters as well. When you look at the Bloomberg Dollar Index, you are seeing some marginal positivity this morning, taking a euro dollar at about 107. So weakness in some of the European currencies. Cable is the exception to that story, where you are seeing 126 there. And I think it's important to simply because that's coming off of the jobs data. When we just talked to Anna Andrade and Sophia Horta-Costa about how the pricing might actually change. But then you've got the Swissy in there shaking things up as well. It's actually one of your biggest index contributors in terms of the dollar strength you're seeing right now. The Swissy weakness against the dollars is certainly something to keep an eye on.
Softer inflation than many had expected out of Switzerland. So a little bit of pressure coming through for the Swissy. You can see that, as you say, in the Euro-Swiss trade or the Dollar-Swiss trade as well. And then broadly, again, just to recheck on the broader markets, currently down 0.3% across the European Stoxx 600.
And that is all going to factor into the fiscal story, in terms of the regulatory story, especially from the European Union. We're going to zoom into that story. Germany's finance minister says Europe's biggest economy can turn around if the correct reforms are put in place. Christian Lindner spoke exclusively to our very own Francine Lacqua. Take a listen.
Germany has some structural deficits, and these deficits had been covered by low interest rates, by demand from the global markets, and, well, the very cheap fossil energy which we imported from Russia. And now this situation has changed, and the German economy has to find a new basis. I think there is potential for a fast turnaround, given the human capital, the intellectual property, the substance of our economy. But since the circumstances have changed, we have to improve the framework conditions for our businesses, which means reforms for the labor market, which means less red tape. We need investments in the public infrastructure and the digitalization of our public administration. And of course, I think we need a reform of our corporate tax system.
Christian Lindner there, the German finance minister, speaking exclusively to our very own Francine Lockwood. Tom, what struck out to me is he's talking about these reforms. He lays out a laundry list of them. Are we even going to make a dent in that laundry list?
Well, he's part of a coalition, to your point. He's part of a coalition with the Greens, with the SEP, so they have to work together to push through. Those were his aspirations in terms of reforms, but we know that domestically, internally, within Germany, there is some opposition to that. Christian Lindner, of course, wanting to take a lighter touch approach in terms of regulation, want to see an ease back, a pullback in some of those regulatory pressures that he would see them in the German economy. But crucially, this is a pivotal moment for this economy. They don't like the sick man of Europe phrase. They push back on that, and we hear that from executives as well. Christian Lindner's spelling out what he thinks is needed, the policy prescription. But as you rightly say, will it actually be implemented?
I can't remember who said this, but Oliver Crook, our German correspondent, talked about this. Someone said they needed a cup of coffee rather than the actual full-on illness, if I recall. But I can't remember who it was that actually had
It was Lindner. It was Christian Lindner.
Oh, it was Lindner. Okay.
That's right, yeah. And he was saying, look, we need a caffeine boost, basically. But part of that caffeine boost will be that regulatory change that he's talking about to free up the enterprise of Germany as they adjust, of course, to an environment where they don't have that gas that's coming through, of course, from Russia. And he talked about the rates environment, the fact that they've been able to fund this deficit with negative interest rates up until, of course, the last few years. That dynamic also changing. Now, something else that's domestically occurring in Germany has been in the last few weeks, but also in other Eurozone countries as well, the likes of France, but also Poland, are some of these protests that we've been seeing. Recent months, farmers across Europe have taken to the streets protesting tax increases, regulation, and bureaucracy. Is there bureaucracy in the Eurozone? In a year of elections, agriculture has increasingly become a key battleground in a global culture war over money, food, and climate change. Bloomberg's Oliver Crook reports.
The farmers have had it. They've taken to the streets across Europe, protesting cuts to tax breaks, competition from cheaper imports, onerous environmental regulations, and sprawling bureaucracy. The spark came from Germany, where the government rolled back agricultural diesel subsidies. If that sounds familiar, that's because in 2018, it was a seemingly innocuous fuel tax that unleashed the Gilets jaunes across France. France is the biggest agricultural producer in Europe, worth about 100 billion euros every year, but still imports about 50% of its fruits and vegetables. In Germany, agriculture employs less than 1 million people, but it accounts for more than half of the nation's land use. Across the board, though, in GDP terms, agriculture is minuscule. But in very real terms, what is more important than feeding your population? Plus, issues from climate change to the war in Ukraine have highlighted the importance of local food security. In Germany, a partial backtrack by the government wasn't enough. Nor in France. Even the EU has had to flinch. What makes it even harder for politicians is the overwhelming support for farmers by the broader population. Agriculture benefits from huge subsidies. About a third of the whole EU budget goes to farmers, to the tune of about 55 billion euros in 2021. Plus, German farmers enjoyed record-breaking revenue last year. But when you speak to them, it's not just about money. There's also an impression that lofty climate and trade goals are being issued by lawmakers far from the soil that grows the food that sustains them, and an impression which anti-establishment politicians hope to harvest in a year rich with elections.
Okay, that was Bloomberg's Oliver Crook on today's Big Take. You can read more on that story, NI Big Take, go on your Bloomberg or visit Bloomberg.com. I just have to note that if you have a tractor, it does really amplify your protest, doesn't it? You can have 100 people, 100 farmers coming out onto the streets. If you have 100 tractors, then that causes real disruption and gives them a lot of leverage. If you have other protest movements where every individual had a tractor, well, that would be something else. So I wonder if we are over-amplifying, or at least some policymakers may be doing a knee-jerk reaction to a protest that's actually relatively small in number, but really significant in terms of the blockages to some of these capital cities as a result of the fact they simply have these massive tractors.
Yeah, it's a fair point. It's not like there's a tractor tow truck that's easily accessible.
It's a bit challenging, isn't it?
It's also not like there's a ton of space there. Do you do a tractor parking permit? I don't know how Europe works here, but I feel like that's the way it would work.
And the other really important, I'm being a little flippant on the tractors, but I do wonder if it does amplify the protest movement there. But the really other important thing is what's happening in Poland as well, because you're seeing real angst and anger in Poland about grain shipments from Ukraine.
Yeah.
That is very significant as well, and that is a story certainly worth monitoring, and we will be doing that, of course, across Europe. Let's check in on the European markets now. Broadly across stocks, it's a day of a little pressure, down 0.3%. Of course, we're waiting for that CPI print out of the US. The bond markets arguably a little bit more interesting, though, today in the session, Kriti.
They are, and it's all potentially going to change when you get that CPI report, the 10-year yield at 4.18. But again, something that we really want to keep an eye on is also what the read-through is cross-asset, because we keep having this conversation where if you start to see some sort of knee-jerk reaction in the yields picture, and we're certainly seeing it in the gilts market today off the UK wage data, do you then have some sort of ripple effect in terms of the stock market? Do you have some sort of ripple effect into, of course, the FX market off those interest rate differentials? And I would even go as far to say even in the commodity space, because that inflationary dynamic is still so tied between the bond market and the commodity space. And this is why the agricultural farmers conversation is so important as well, because the EU is already making concessions on that front. Marginal concessions, one would argue, but still concessions nonetheless. Does that then change the pricing of some of these kind of parts of food around the world? That all feeds into some of the inflationary numbers that we might get later today.
Yeah, absolutely. And so far, of course, stocks have been able to power through any higher yield story, at least so far year to date. And then we'll see whether or not that dynamic changes on the back of the CPI print today, whether or not high yields, if that comes through, if it comes through hotter than expected, whether that challenges the stock's momentum that we've been seeing.
Yeah, it all comes down to, again, so many different pieces that we could dive into. Give us a CPI report. Tom McKenzie and I will talk for hours. Coming up on the program, we discuss all things energy. Again, a crucial part of that CPI report. Fatih Birol, the IEA Executive Director, joins us next. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always going to be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
DOJ or other authorities.
Could face bigger challenges.
Britain's next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
All that does is raise taxes on the American families and our small businesses that we need to be taken care of. It is ludicrous that he wants to go and raise those tariffs to everything that we import. That's going to affect American families on anything from baby strollers to appliances. Every American family will see at least a $2,800 increase in their taxes.
U.S. GOP candidate Nikki Haley there on Donald Trump wanting to impose tariffs on Chinese goods. We know that he has in the past, Tom, talked about 60% or more. Those comments coming on Fox News as well. I think it's important context that Nikki Haley has been branding herself as the fiscal conservative, as the expert on economics, to Trump's I'm the expert on business. And that's kind of the platform that he ran on. So her talking about, and previously talking about fiscal deficits, et cetera, talking now about the inflationary story off tariffs, it's pretty stagnating.
Yeah, she was also asked whether she would roll back any of the tariffs that remain in place because, of course, as you say, Trump put in tariffs on over $300 billion worth of Chinese goods. President Biden has not rolled those back. She was asked about that. She said, well, China's a little different because of what it's been doing in terms of its abuse of the relationship with the U.S. as she defines it. Yeah. But you're right. Yeah, she pushes back 60% tariffs. Look, frankly, you go to a Walmart and you're looking at 60% tariffs. You are going to, I don't know if her numbers are correct, but you are going to feel as a U.S. consumer the impact of 6% tariffs on Chinese goods if you're shopping at Walmart or, frankly, any other big name brand or store in the U.S.
I love that you mentioned Walmart. You never hear that in London. Have you been to Walmart?
I'm just trying to draw you in.
Yes, he's just trying to bait me here. Let me tell you, I love a good Walmart. We need more in London, I think. But to your point about the inflationary story, it's not just about the goods itself. It's about the commodities picture as well. Prices at the pump. What do food prices look like as well? All of those are going to feed into the CPI report later today, especially that focus on oil.
Absolutely. Oil currently, Brent at $82, up 0.3%. WTI at 77.15, up 0.3 as well. So a little bit of price increases coming through for oil. Let's get more analysis on this then as those prices move slightly higher. $82.24, as I say, on Brent. And let's bring in IEA Executive Director Fatih Birol standing by for us. Sir, thank you very much for your time. Let's start then with your view on prices for oil, or at least where you see the demand picture heading in the months ahead through this year. Is the demand picture starting and continuing to soften? Where do you see prices by year end, sir?
So this year, 2024, we expect oil demand growth to be significantly weaker than last year, 2023. The increase we expect about 1.2, 1.3 million barrels per day, mainly as a result of the slowing down of the economic growth, China, but elsewhere, and also electrification of the transportation system, more electric cars coming in the picture. This is on the demand side. On the supply side, the growth coming from Americas, namely US, Canada, Brazil, and Guyana, this growth, put all together, is more than enough to meet the global oil demand growth. So in the absence of major geopolitical turmoil or major extreme weather events, we would expect rather a comfortable oil market and comfortable moderate price evolution throughout 2024.
Okay, moderate price evolution throughout 2024 because that supply is there, as you say, from the Americas, but demand is going to be softer. And of course, you make that key caveat around geopolitical risks. Does that give us some comfort when it comes to the question of inflation, Fatih? Do you think that we are past the big concern, at least around the resurgence of inflation when it comes to the energy component and the energy mix in that inflation story?
So, at least what I can say, if there are no geopolitical escalation in Middle East, we are seeing a tension growing and then again reducing. And if we don't see any extreme weather events in North America and elsewhere, I would say that the oil prices remain at around current levels would help the inflation not to further increase. So as such, it would be a good news for the global economy, especially in the emerging countries.
Fatih, it's Kriti Gupta in London. OPEC Plus has time and time again talked about physical tightness in this oil market, and it's that physical tightness that helps them kind of regulate some of the oil prices to perhaps a lot of the consuming economies kind of demise, to be completely honest. Talk to us a little bit about whether the United States, that extra supply that you touted, distorts the oil picture. Are you concerned at all about oversupply from the U.S.?
No, I think the growth coming from United States is welcome for the oil markets because, as I said, the demand is weaker than last year, but still significant, 1.2, 1.3 million barrels per day. And the U.S. bringing a significant amount of oil is a very good news for the consumers, for the global economy, for inflation, as well as coming from Canada, Brazil, and Guyana. The Americas altogether cover the global oil demand growth and put a downward pressure on the prices and reduce the room of maneuver for the countries who want to control the oil production and consequently the prices.
Is this a good time, though, for that to actually happen in the context of some of the tensions we're seeing in the Red Sea? Several oil tankers being hit in that part of the world, in addition to longer fuel times, more labor. Fatih, when do the Red Sea tensions show up more aggressively in the oil price?
I think currently, when we look at the picture in the Middle East, we don't see any of the major producing countries are affected from those tensions, and the transition routes becoming longer. They may have some marginal effect on the prices. My worry is if we see one or more than one major oil producing countries is directly involved in the current crisis, and if we see escalation of the issue, the situation, this may well definitely push the prices up, and this will be definitely not good news for the global economy.
And certainly that is a risk, no doubt, that OPEC Plus are factoring in. They have their cuts coming through till the end of March. Are you seeing compliance with those OPEC Plus cuts in terms of the output, Fatih? And do you expect OPEC Plus, that cartel, to push out those cuts further into the year?
So I think by and large, there is a good discipline there when we look at the numbers, and what they are going to decide for the next steps is, of course, up to those countries. But as we discussed a few minutes ago, the inflation is a major risk for the global economy, and I think we all need to avoid to take steps which would fuel the inflation, including the higher energy prices, higher oil prices than we have now.
What is the demand picture looking like out of China at this point?
Chinese demand is weakening compared to last year for two reasons. One, the Chinese economy is slower compared to last year, and the second, the electrification of the transportation sector. As we speak now, every second car sold in China is an electric car. So therefore, in addition to the slowing down of the economy, demand is getting weaker because of the transportation sector electrification is continuing, and it will continue in China and also beyond.
Fatih, a big question around one of the calls that the IEA has made in the past, which is that oil demand will actually decrease by 2030 in response to some of the clean energy initiatives around the world. Well, since then, you have seen several governments around the world pull back on some of those clean energy initiatives simply because they are touted as being too expensive. President Trump itself has been talking about creating more and more growth in the oil sectors within the U.S., which of course creates a lot of the GDP there. Talk to us about how the IEA is thinking about the effects of a Trump presidency.
Yeah. So first of all, we said you are right. Global oil demand would peak before 2030. It will not stop or go down from overnight to zero, but peak before 2030 for two reasons. One, the clean energy is moving faster than many people realize. Just last year, 2023, more than 80% of all new power plants built in the world were renewables. And about 5% nuclear power, only the rest fossil fuels. This is nothing to do with the climate, which is more because of they're cheaper. Second, electric cars, they are booming across the world. For nuclear power, we see a major comeback. They will weaken the global oil demand growth. And plus, I think we should see what is happening in China. In the last 10 years, more than 2/3 of the global oil demand growth came from China only. And Chinese economy increased more than 6% per year. And Chinese economy is slowing down, and therefore it is demand. So putting these things together, slower Chinese economy, which is the single most important driver of oil demand growth, and the clean energy transition around the world, we think we are going to see before 2030 a peak of oil demand. And we are not the only one. After we said it, several companies, oil and gas companies in Europe, repeated the same thing.
Okay, so you still see that peak in terms of oil demand before 2030. When it comes to the transition story, then briefly, before we let you go, yes, some oil companies here in Europe are investing around that transition, but frankly, it's pretty marginal, and their US counterparts are barely doing anything at all. What would you like to see in terms of the policy prescription to encourage those oil majors to do more to fund that transition?
So many oil and gas companies, their leaders in Europe, United States, and even Middle East and elsewhere, they are saying their companies are, on one hand, continue with their traditional operations, but for them, climate change, clean energy is very important. And when you look at their speeches, statements, strategic documents, big chunk of it is dedicated to their efforts they are claiming they are doing on clean energy. But at the IEA, we look at the numbers. When we look at the numbers, 2023, only 2.5% of the investment in the oil and gas industry goes to clean energy, 97.5% the fossil fuels. What I wish from them, that there is at least a similarity in how much they dedicate their speech to clean energy and their investment portfolios.
Fatih Birol, the IEA Executive Director, we thank you so much. We do have to leave the conversation there, but we appreciate the insight on what the oil picture might actually look like in the next decade or so and what the factors are contributing to that story. Of course, coming up later today, we've got a slew of great interviews. Apollo Asset Management Co-President coming up, as well as a Harris Associates partner and International Equity CIO. The Pulse is up next. This is Bloomberg.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Stronger than expected wage growth in the UK reinforces the Bank of England's caution against moving too quickly to cut rates. In the U.S., members of the Federal Reserve say they're looking for broader disinflation to signal rate cuts. The latest CPI report due in a few hours. Plus, President Biden pushes for a 6-week pause in fighting in Gaza as Israel launches more strikes on the crowded southern city of Rafah. Now let's take a look at the European markets map. Again, European stocks, but also U.S. equity futures, I think finding their feet a little bit. They posted some small moves in a pretty cautious trading environment. And this is before the release of this very keenly awaited inflation data that could provide clues on the timing of the Federal Reserve interest rate cut. Now I'm looking at auto stocks. They're actually on the rise in Europe overall. Michelin rallied after the tire maker's earnings and share buyback announcement. And then a couple of other things that we're looking at is, for example, oil after the big move in the last couple of days. Then pound strengthening after UK wage growth slowed less than expected in the fourth quarter. Again, this may underscore the Bank of England's caution against moving too quickly to cut interest rates. Unemployment ticked down to 3.8%. Now, joining us to talk about the UK, and then we talk about U.S. inflation, and Andrade from Bloomberg Economics. Anna, thank you so much for joining us. I mean, the Bank of England does not have it easy, and I feel like they haven't had it easy for quite some time. Can you break down the data for us and what this actually means for the BOE?
Yes, sure. So today we got a surprise reading on the wage growth, which is actually the most important data detail in the release. It came in, it had been falling fast, so that would have been good news for the BOE, but it came in, it fell to 6.2% in the last 3 months of the year, and we and the Bank of England were expecting it to fall to 6%. Now, that obviously lifts the risk that the BOE acts a little bit later than we expect. Our base case was that they were going to cut rates by May, but for the time being, we're sticking to our view. Yeah. And the reason for that is because we essentially think that out of all the data that's coming over the next week and over the next months, the most important one is inflation. Because essentially, if you get headline inflation down, that feeds through lower inflation expectations, and that will feed through to lower pay demands.
So, and we get CPI tomorrow. I guess the concern for the Bank of England, and we were following that decision last time with the press conference, is that we also don't know when on March the 6th the Chancellor comes up within his budget, and that could have inflationary pulses.
No, definitely. I mean, what the inflationary policies of the budget will largely depend on the sort of tax cuts, that we get, because as we've seen in the previous budget, what we saw was like a big chunk of tax cuts, but because they also stimulated labor supply, then they weren't so inflationary. So that's what the BOE will be looking for. But now with inflation coming in tomorrow and ahead, I mean, tomorrow we're going to get a slight tick up in inflation, which will be sort of an awkward reading, but what matters is what inflation does next. And until May, we still have 3 readings of inflation. If it comes in line as we expect, that means that headline inflation will be undershooting the 2% from spring, and that should give the BOE enough reason to start easing its policy a bit.
Anna, thanks so much. Anna Andrade there from Bloomberg Economics. Now, we're also joined by Grace Peters, Global Head of Investment Strategy at JP Morgan at Private Bank. This is a big day, Grace, for the market, so I love having you on. We talk about everything from, what the UK does to the Fed. In general, I don't know whether the question is, if inflation's coming down enough for really central banks to start cutting, or whether the question should be, how difficult is that last mile going to be to get inflation under control?
So we think that there's clear disinflation trends, and that is going to continue. I mean, the wage picture is certainly a part of it, and a part that needs to be watched closely, whether it's in the UK, and of course thinking back to the jobs data that we got out of the US. Now, US wages had come down to that 4.2, 4.3% range if we think about average hourly earnings. We got that tick up to 4.5%, which is a bit concerning. But again, that could just be part of the January data blips that we've had in the last 4 years. So disinflation, we think, is here to stay. And as an example of that, I was really encouraged to see overnight the New York Fed consumer inflation expectations that showed over 3 years, consumers still think inflation is falling quite significantly.
Well, great. How much of a mismatch is that with that, incredible employment figures that we had?
Yes, it's certainly a key part to watch. I don't think one data point makes a trend at this stage, and the broader body of data still supports disinflation. We're expecting core PC at 2 to 2.5% by the end of the year, and we still feel really comfortable with that. The other elements that we're going to be watching within the print later is going to be goods price inflation. We've obviously seen disinflation driven by both goods and services, and whilst it's a little bit early, we still want to make sure that when we think about events in the Red Sea, some of those delayed shipping, that's not feeding through. It's probably a bit early, but still watching goods price inflation. Services, obviously, wages feed into that, shelter as well. But on balance, disinflation. I would say, Francine, though, that despite expecting CPI to print below 3% later, we still think that the market is over-exuberant when it comes to when that first cut comes in. So our base case, and has been for a while, is that it's June that we get the first cut from the Fed. And we'd view that as a good thing. We don't need to push the Fed, to move too soon. We think they're doing the right thing by waiting until, you've got a firm body of data.
So, Grace, is the danger if they go too soon that then they have to reverse it?
I think that's right. And that would be a real, negative for the market, I think. Rather just, wait an extra couple of months to get the data that you need to, once you start cutting, you're definitively on that path, rather than have to cut, then pause and raise. So I would rather see them, hold out until June or when the data justifies that.
And do you think the Fed has to cut first? I mean, this is kind of like
no,
debate.
I think it might be the ECB, actually.
They'd be brave enough?
Well, I think the data is significantly weaker. Like when we look at all the data coming in from the US, I mean, even if we just think about GDP, consensus is expecting Q1 GDP to fade to around 2.5% for the US. But the nowcast data implies it still starts with a 3, so all the data in the US is coming in stronger, and in Europe it's hovering around 0. So we've in our official forecast we've got June for both the Fed and the ECB, a little bit later actually for the Bank of England because of the wages and the inflation situation. But if I had to say who was more likely to go before the baseline of June, it would be the ECB.
And so, Grace, what does it mean on how you play the markets? I know we've talked about credit before, but has your view changed in the last couple of weeks?
Our views haven't changed. I mean, equities have really been where our focus has been. We were sort of bullish last year, we're bullish this year. But I will say, having sort of increasingly taken our price target up for the S&P, it's at 5,100. So the active debate now is, you know, do we take it up to our bull case, which would be 5,300? We feel comfortable holding with the current scenario at the moment. We were waiting for third quarter earnings, and we're really happy with what we've seen there from the Magnificent Seven, but also from other parts of the economy. And that applies to Europe as well as to the US. Some really strong results out of Europe, particularly in sectors that the market had got concerned about, like luxury goods, fears over the China slowdown. We got some really good numbers out of that sector. And so our sense is, you know, it doesn't matter too much whether the Fed cuts in June, a month here, a month there. Yeah. The underlying earnings picture is pretty strong, driven by that economic and consumer resilience.
Grace, earnings was a little bit funny in certain cases. That I feel like there were sectors where it was really, you know, a tale of two halves. It was companies that were beating expectations and others that weren't. Does it mean that it's a little bit of a crowded space within sectors?
Well, I think the trade that everybody feels is crowded is technology,
Tech.
and specifically the Magnificent Seven. But we saw some of the strongest beats out of that group. Maybe not all seven of them, but in aggregate, you had over an 80% beat rate for that group versus 70% broadly for the market overall. And I actually think there's too much focus put on the sort of the concentration risk of that group. Earnings growth is far superior, so we're looking for about 25% earnings growth from the Magnificent Seven. Versus, high single digits from the rest of the market. That's for 2024. But even in 2025, earnings growth will be higher. It's cash flow. I mean, share buybacks will be a big driver of the market, and large cap tech are
and we've seen that
half. Yeah. Exactly. Some positive surprises on dividend announcements as well as share buybacks through earnings. So I don't want to sort of create the impression that that's the only story in town. I think there's more than just artificial intelligence. Security is another big theme for us. But I wouldn't get overly hung up just on the concentration risk. It's earnings and cash flow that we feel pretty optimistic about.
I need to talk to you about commercial real estate, but maybe we'll do it in a couple of minutes. What have we learned about China? Again, a lot of policy support, unclear how far policymakers maybe want to go.
Yeah, I think we see two broad issues in China. One is, outright disinflation, so which is obviously at odds with the developed world, the rest of the developed world, and the other is the property sector that needs more than what we've seen so far to really kickstart it. So, I think helpful steps. Certainly, it feels like a line is being drawn under the equity market, but as to whether this could lead to a sustained rally, we actually prefer within emerging markets to look elsewhere. So India is our preferred market because you see a very tight correlation between the GDP delivered by India and the earnings growth delivered by the region, and that's what we want to invest in.
Okay, so interesting. We'll maybe talk a little bit more about India next. Staying with us, Grace Peters from JP Morgan Private Bank. Now, much more to come. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think it's too soon to have an expectation that, or to measure or project when and how much I think we might be lowering the policy rate. I think the progress that we're making on inflation is very positive. As long as we have continued progress at the current policy rate, I think at some point it will be appropriate for us to lower the federal funds rate. I don't see that in the immediate future, and I don't want to prejudge what our decisions might be going forward this year.
Well, that was the Fed Governor, Michelle Bowman, basically saying that it's too soon to know when or by how much Fed officials will cut rates. She basically also said that she does not see rate cuts as appropriate in the immediate future. Now, still with us, Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. And Grace, you're expecting actually the first rate cut from the Fed in June, which is a little bit of an outlier call. Going back to, what Fed cuts mean for emerging markets, what we've learned from emerging markets, certainly looking at earnings and also the sales of luxury, are they stronger than we expected?
Yeah, so I think, as an investor, when you're thinking of investing outside of the US and specifically into emerging markets, you want to know that you've got superior growth, the EMDM growth premium, because there does come often more volatility and more risk. And so when we think about which emerging markets are delivering growth that you as an equity investor can then capture through corporate earnings, a shareholder-friendly environment, India to us is top of the list. And so when we're thinking about a region that's still quite early in its economic development, you're still seeing growth rates, GDP growth rates, 6-7%. And we look at the correlations between that GDP and the earnings growth. India does stand out to us. Now, the pushback is always, isn't that in the price? It's expensive. But I think that is the case for many of these, growth type areas when it's quality growth, and that shouldn't necessarily be a prohibit to investing. Just like you don't buy something just because it's cheap, you shouldn't not invest just because it's expensive.
But so do you break it down by sectors? So, there's also a lot of infrastructure, money that will have to go into India. Is it the telecoms, roads, or do you play it through fixed income?
I think, no, I'd play it through the equity market, and I think infrastructure is one part of the story. I think the consumer is another part of the story. When we think about the huge rise in the emerging middle class, the story that we used to talk about for China for many years, we can apply a lot of that to India as well. We know that this is a young, dynamic, educated, tech-savvy workforce, and the growing middle class. I think going back to the luxury goods conversation we were having as well, there's huge potential for brands to grow in India, as well as obviously the rise of the domestic brands there as well. So I think it's quite a broad church of options when you invest in the region.
Do you choose? How do you choose actually between the domestic ones to the international ones that can get a bigger footprint in emerging markets?
So it also sort of depends a little bit on what you're trying to achieve from a geographic exposure, but one very clear way to invest in emerging markets if you don't want to go in the region is to invest in Europe. When we think about one of the key advantages of investing in European companies, and we talk about European national champions, businesses that are listed here but actually sell the majority of their revenues are outside. Luxury is one part, but also you can invest in materials, you can invest in industrials, and so all of that's appealing. So you can do it through Europe, through the developed market, or you can go in, and I would be more selective with an active manager if you go into in India as a region, but we think that there's a lot of potential there.
So interesting, Grace. Thank you so much for joining us today. That was Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Coming up, we discuss the stock market frenzy for artificial intelligence with Shmuel Shafetz, founder and chairman of the VC firm Target Global. That's coming up shortly, and this is Bloomberg.
Buffett is somebody you've met and you know. What does he tell you about investing? He tells you to just do what he does, or what does he tell you?
Pretty much. I mean, one of the things, we have this great connection about the love for baseball. And the reason why Warren and I got to know each other is he insured my contract, the 252. I reached out to him and I said, Warren, now that we're business partners, maybe I can come see you in Omaha. I thought I would never get an email back. And Debbie, who's been with him for over 40 years, wrote back and said, how's October? I said, I'll be there because we're not going to the playoffs. And that led a series of 5 or 6 years where I go back to Omaha. And he said, Alex, you always want to be a gentleman. You want to be a great baseball player. And then the 2 rules of investing are, 1, never lose money. And number 2, don't forget rule number 1.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Shares are lower in U.S. pre-market. Overall, the chip designer, though, has almost doubled in market value since last week. Now, that's after the British company made the case for how it will benefit from the artificial intelligence boom. The rally has also lifted shares in SoftBank, which owns around 90% of ARM. Now, let's discuss the future of AI with Shmuel Shafetz, founder and partner of the venture capital firm Target Group. It's invested in more than 100 tech firms, including the fintech company Revolut. Shmuel, thank you so much for joining us. I mean, if you look at the Magnificent Seven, that I can never pronounce, it's incredible how much of a lift they have because they're associated with AI. The companies that are less AI focused, maybe Tesla, are not rallying as much. Are we overdoing it?
I think so first of all, I think it's very easy to overestimate the short-term impact of AI, but to grossly underestimate the long-term impact. It's, for the first time, I think, in software, we're seeing a real shift in technology that's happening from within big firms, not within startups. So you see that the LLMs that are built within the big companies, and I'm including OpenAI, which is basically today's subsidiary of Microsoft, are leading innovation. So I actually don't think it's overstated. I think these companies will have a disproportionate piece of this new market, so they can see a lot of lift in their core businesses.
So what does it mean for how you invest? Because it must be more difficult. Like, do you invest in companies that could then be acquired by the big ones or add something? Like the investing landscape is changing quite significantly.
It is changing. I think we're investing less. We're investing less right now. I think a lot of people are investing less. Yeah. We understand that 24 is going to be a year where the shift is going to start to really hit the market. Yeah. And I think for us as venture investors, we have to take a pause for a minute, try to understand how the market changes, and try to adjust ourselves. Because I think the old model of venture investing is, in software particularly, is just not going to work anymore.
Because what? Because the big companies will dominate that space with internal funding?
First of all, and they have enormous amounts of capital, right? From shareholder equity to just cash, enormous cash flow that they can buy with, but they can also build. But also because a small group of people working on one of those platforms can build what hundreds of engineers used to build. So we're seeing companies that had tens and hundreds of millions of dollars of venture money invested in them get challenged by 6 people in a garage. It's almost a throwback to the 90s, right? Where enterprise software companies started to get hit by 90s, early 2000s by these younger startups. So it's just going to it's going to shift from engineering as the core to customer experience, business development, and more than anything, data.
the access to good data sets is going to matter more than anything, and that's going to be the differentiator.
But how do you look for bubbles? So I remember, early 2000s where even some of the big banks were like bigbank.com, and now it's like big bank AI. How do you, separate the real value plays to the rest?
That's a great question. I wish I knew. Would have made my 22 much better after grade 21. But look, I think in the end, we know to recognize when someone has a real tech dividend.
Yeah.
So in the end, AI is going to be ubiquitous. Yeah. The whole software world is going to be operated on generative artificial intelligence. So everybody's going to benefit. Mm-hmm. We obviously have to be careful from the FOMO effect and from chasing after something that clearly has no product market fit yet and is completely disattached from any economic realities, right?
Yeah.
And that's, we're starting to see it in some places in this market. It doesn't mean, by the way, I think we saw all these banks being bank.com, and all the banks today are basically tech companies and internet companies, right? They all have great services. So they did make the shift. And all the companies that are talking about, a lot of companies that are talking about AI, it will take time for them to actually get something out of it, but I think a lot of them will end up getting a lot of benefit.
Shmuel, I know Target Global was also in the news because of links to Abramovich and Russia. Has that impacted the way you do business?
So we did have, like I think almost any other firm in Europe, money from Russians before the war, before the invasion. When Russia invaded Ukraine, we obviously severed those ties, and one of my partners, Alex, one of my co-founders, left the firm voluntarily to protect our portfolio companies, and that's unfortunate, but it had to be done.
How's funding in general? A tough environment?
It's a tough environment, and I think it's justifiably tough, right? I think, again, it's hard to invest today when the future is so unpredictable. But I think this year is going to be a year of shift, and 25, 26, 27, I think we'll see a better year. And by the way, it's regardless of rate cuts and macro. I just think there's so much opportunity around AI that once we find the right tack, the industry will start to sort of bounce back.
Shmuel, thank you so much for joining us today. That was Shmuel Chafetz, founder and partner of Target Global. Coming up, we preview the latest U.S. CPI report, which is due in a few hours. We'll also have more from our interview, the U.S. Republican candidate, Nikki Haley. That's next, and this is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Top top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg.
Well, stronger than expected wage growth in the UK reinforces the Bank of England's caution against moving too quickly to cut rates. In the US, members of the Federal Reserve say they're looking for broader disinflation to signal rate cuts. The latest CPI report is due in a few hours. Plus, President Biden pushes for a 6-week pause in fighting in Gaza as Israel launches more strikes on the crowded southern city of Rafah. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So markets eagerly awaiting the latest U.S. CPI reading later to confirm the view that the Fed has brought inflation back under control. Now, economists predict the headline CPI will come in below 3% for the first time in nearly 3 years. Well, joining us now is our MLife strategist, Sven Ram, and Sofia Ortega-Costa from Bloomberg Markets Today blog. So thank you both for joining us. Sven, let's start with you. What are you expecting from this inflation report? And actually, will it be enough for markets to be convinced either way of what happens next for the Fed?
Morning, Francine. I think I'll be looking out most crucially for the core inflation data. As you know, it's expected to come in at 3.7%, so almost 4%. And that is hardly a number that is going to give the Fed any confidence that inflation is under control now. As you mentioned just now, they're looking for broader parameters that inflation is coming off the boil. Now, independently of that, the markets think that there is a fair chance that we will get a rate cut in May. I think June is more likely. Why do I say that? Because the Fed, as you know, has penciled in 3 rate cuts this year. And if they go in June, there will be 4 other meetings in which to seek 2 rate cuts, which means they go in alternative months. And that would work out just perfectly fine. But if they were to cut rates in May, that would muddle the messaging because they would have 5 more rate meetings in the remainder of the year in which to get through 2 cuts. And that would be an awfully complicated messaging to say, oh, we will cut randomly in September or November or whatever. So I think that markets should be positioned more for a June rate cut.
And Sophia, how does this play out? Again, if you look at some of the Treasury gains that have been a little bit short-lived, there's a lot of market kind of anxiousness about what happens next. A lot of this is already priced in, the cuts.
It is, and I do think if we zoom out a little bit, will this actually change the narrative for markets and for the Fed? Markets tend to think in hours, in days, right? And they try to price things in. And what we have seen lately is a kind of a big reaction to U.S. data, and then things settle and, markets carry on as they were. So will this really change the narrative? I think, it would need to be a very, very big surprise in either way. What we're seeing, Fran, there was a huge gap between what the Fed was saying and what markets were expecting the Fed to do. We're seeing that gap narrow. It does seem that markets are kind of growing more comfortable with perhaps a later than expected cut from the Fed. What Ven was saying, maybe June is more likely. That's what markets may perhaps have to get to grips with. But again, the messaging from the Fed has been very clear. It's unclear, though, whether waiting too long will give them the information they need. So there's a balancing act there as well, Fran.
Yeah, and will it, Ven, this is a very good point, is that if they wait a little bit longer, do they protect themselves against everyone's worst concern, which is that they kind of then have to rise quite quickly?
Yeah, I think that it would be too premature for them to cut any sooner because, they are mindful of what happened in the 70s and 80s because at that point, the Fed was keen to cut rates and they did cut rates and then that restoked inflation all over. And this Fed under Powell is acutely mindful of the risks surrounding a resurfacing and reacceleration of inflation, which is why they want to see inflation disinflation broaden out. And as Neil Kashkari said the other day, they want more good inflation prints rather than just going right now and cutting rates imminently. After all, the economy has proved extremely resilient. Demand is still good. The labor market pressures are still strong. So there is no incentive for the Fed to go in just yet.
And I guess the question on the markets is why was the jobs number so strong?
Yeah.
And until we figure that out, it's going to be very difficult for the Fed, I guess, to do anything too decisively.
Yeah, exactly. And to Ven's point, why would the Fed need to cut, right? I think that messaging needs to be very carefully calibrated because if it's cutting because it sees that the inflation fight is over, then it needs to be very sure of that, right? But if it doesn't need to cut and we have policy this restrictive and the economy's still okay, the jobs market's still okay, you're still seeing strong domestic demand, then why would the Fed need to cut in the first place? It does have the luxury of time, which is something that maybe policymakers here in the UK and in Europe don't have, where they are seeing pockets of weakness in the economy and they do need to move a little bit faster.
Ven, do you think the ECB goes first in terms of cuts?
I think that the ECB is going to go in June. I still believe what Christine Lagarde told you in the Davos interview. I still stand by that, and I think that markets are a bit premature in pricing an April rate cut. I think June is more likely to happen, and definitely likely to happen.
I know you have a great piece, of course, on what gilts could do. Ven, it doesn't feel great, I guess, being the Bank of England governor, because you have all the pressures of other central banks with that extra layer of uncertainty.
Absolutely. I think the Bank of England is caught between a rock and a hard place. As Sophia was saying, there are pockets of economic weakness. But at the same time, if you look at wage pressures today, those numbers are not going to give the BOE any confidence that, price formation and wage settings are conducive to a rate cut just yet. We have got services inflation, which is supposed to accelerate to almost 7% in January, and we just got the wage data this morning. If you take those two together, it's very hard to conclude that headline inflation is going to crumble to 2% anytime soon, and that is bound to keep the Bank of England pretty wary.
Yeah, and Sophia, I like Ven's piece today saying, look, the Bank of England pricing centered around June looks a little bit tenuous. Are we going to see more swings in pound or gilts than anything else? Because, again, it's a little bit more fluid maybe than other places.
It is, and actually we tend to look at the pound versus the dollar, but I think the interesting movement is in the pound-euro, and the pound actually strengthened to the highest in 6 months versus the euro today, and that's really kind of the market saying, we do think that the BOE is how Ven describes it, between a rock and a hard place, where it's still fighting the inflation fight, but at the same time it's grappling with pockets of weakness in economic growth. The ECB doesn't really have that much of a problem, especially when it comes to fighting inflation. But I think some of Wall Street is actually saying the pound is a good bet, but expect more volatility in the months ahead, especially as we get this data feeding in, Fran.
Sophia, you're also a great China watcher. I know there's Lunar New Year, so for the moment there's a couple of days off, but actually what are you watching out for in the Chinese economy in the next couple of weeks? Commercial real estate, yes. Tick. Anything else?
Tick. Well, actually, the Lunar New Year period tends to be quite a key consumer spending period. So watching out for any data on cinema ticket sales, on travel, on restaurant spending. The consumer story is a very important story for policymakers in Beijing. But also, let's see how the market has digested those capital market support measures and the new securities regulator announced just before the holiday. Whether the market is actually more convinced that will make a difference at all, whether there'll be more forceful measures to support the stock market, which has been an incredible underperformer this year. But in terms of economic signals, whether the consumer story is working or not, I think there's still risks there, and any communication from Xi Jinping's government on plans to support that will be keenly watched as well.
Sophia and Ven, thank you so much for joining us. Bloomberg Sophia Ortega-Costa and our MLive strategist, Ven Ram. Now, coming up, President Biden pushes for a 6-week pause in fighting in Gaza as Israel launches more strikes on the crowded southern city of Rafah. That story is at next, and this is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Welcome back, and let's turn to developments in the Middle East. U.S. President Joe Biden is pushing for a plan to pause fighting in the Israel-Hamas war in order to free hostages. Now, Joe Biden spoke following a meeting with Jordan's king at the White House and said those conditions could lay the groundwork for broader peace.
As the king and I discussed today, the United States is working on a hostage deal between Israel and Hamas, which would bring an immediate and sustained period of calm to Gaza for at least 6 weeks.
Well, joining us now is Bloomberg's EMEA News Director, Rosalind Matheson. Ros, thank you for joining us. So what are the key difficult points in getting a proper ceasefire?
Well, there's two main sticking points in all of this, and the overarching one is really what would happen after a short-term ceasefire, is the understanding that this paves the way for a permanent ceasefire. Secondly, of course, is what happens to the Israeli troops in the meantime. Are they agree that they'll pull out of the Gaza Strip entirely, or do they do a partial withdrawal to different parts of the Gaza Strip? And those are two real sticking points in all of this. Of course, Israel says it cannot agree to a permanent ceasefire as part of this because their overarching goal is to eradicate Hamas, and they've not achieved that. And Hamas says, well, of course, we can't have Israeli troops still hanging around in the Gaza Strip for the long term. And so these are two real problems in these arrangements. Of course, we know there's multiple plans going around, multiple conversations going on. There's another meeting today involving Qatar and Egypt to try and facilitate this. But certainly it seems that those two sticking points remain pretty severe.
So is time running out to get a ceasefire, given Israel is so determined to push ahead with a ground offensive in Rafah?
Well, that is the real impetus to try and get something fairly soon, because the Israeli government has made clear that they plan to launch a ground offensive in Rafah, which is that very bunched up area near the Egyptian border. There's estimates of over 1 million people there at the moment in refugee camps and sort of cordoned off in that area. And the question is, where do they go if there's an Israeli ground offensive there? They can't go into Egypt because Egypt won't let them in. Can they go further north in the Gaza Strip? That's very difficult. And so they're racing against time to try and ward that off by agreeing on a ceasefire, because it's very clear that the Israeli Prime Minister Benjamin Netanyahu intends to do that fairly soon. As he said, again, his goal is to eradicate Hamas, and he says that there are Hamas enclaves around the Rafah area. So it really is that race against time that we've talked about.
Roz, how bad has relationship gotten between Joe Biden and Benjamin Netanyahu?
Well, it's clear there's a lot of tension going on there, both increasingly publicly and no doubt very much behind the scenes. There's lots of reports, unverified, of the exasperation that Joe Biden is expressing to his aides, to officials in the White House, that Netanyahu is simply not listening to him. And that's very clear that Netanyahu thinks he's going to charge his own course here. And that's despite, the U.S. being the major military and strategic ally for Israel in the region, and also a major partner economically, that Netanyahu says, well, I'm doing this for Israel, and that's it. But it's quite, telling. It exposes the limits of U.S. influence over Israel, and that's not particularly a good look for Joe Biden in an election year in the U.S. when he needs to look like he's commanding and in control. The question is, does that spill over increasingly into the public sphere, and what does it do in the long term for the relationship between U.S. and Israel? It does seem that it's on a projected downturn in ties for at least the foreseeable future.
Roz, thank you so much. As always, our news director for EMEA there, Roz Matheson. Now, Republican presidential candidate Nikki Haley has told Bloomberg Surveillance it was a mistake for the former U.S. President Donald Trump to say he would abandon NATO members to a Russian incursion if allies failed to meet their defense spending commitments.
This is a man who has wanted to destroy America and defeat America for years. I dealt with Russia every single day. It is a mistake for Trump to side with Putin over our allies. We needed a lot of friends after 9/11. We better remember that. But it takes a friend to get a friend.
Ambassador Haley, I'm sure you've seen the comments from the likes of Lindsey Graham and Marco Rubio. When it comes to NATO, do you feel like you're potentially out of step with members of your own party?
It's not, the goal is never to follow the polls. The goal is to make sure you communicate what's right. We need to make sure that we have an alliance that's strong. Our whole goal is to prevent war. That's the main thing. I mean, you look at Russia right now. The reason people should care about Ukraine is because, one, it's a pro-American, freedom-loving country. But two, listen to what Putin said. Putin said once he takes Ukraine, Poland and the Baltics are next. Those are NATO countries. That immediately puts America at war. This is about preventing war. This is about keeping an alliance strong. This is about bringing more friends in, not pushing friends away. Donald Trump doesn't get that. And that's what will creep us into war. We can't have that. And so our goal is not to go and blame the American people for feeling the way they do. It's to make sure we get our message out on why they should care and how this is in the best interests of America. And for those politicians who are refusing to say that, that's a disservice to the people that they serve.
Republican presidential candidate Nikki Haley there speaking with Anne-Marie Horder. Now to Germany now, and Christian Lindner, the German finance minister, told us exclusively in a conversation that the country's economy can turn around if the correct reforms are put in place.
Germany has some structural deficits, and these deficits had been covered by low interest rates, by demand from the global markets, and, well, the very cheap fossil energy which we imported from Russia. And now this situation has changed, and the German economy has to find a new basis. I think there is potential for a fast turnaround, given the human capital, the intellectual property, the substance of our economy. But since the circumstances have changed, we have to improve the framework conditions for our businesses, which means reforms for the labor market, which means less red tape. We need investments in the public infrastructure and the digitalization of our public administration. And of course, I think we need a reform of our corporate tax system.
That was Christian Lindner, the German finance minister, speaking exclusively to Bloomberg. Coming up, how the protests of EU farmers have rippled across the world in a hugely important year for elections. That story is next, and this is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Now, in recent months, farmers across Europe have taken to the streets protesting tax increases, regulation, and bureaucracy. Now, in a year of elections, agriculture has increasingly become a key battleground in a global culture war over money, food, and climate change. Bloomberg's Oliver Crook reports.
The farmers have had it. They've taken to the streets across Europe, protesting cuts to tax breaks, competition from cheaper imports, onerous environmental regulations, and sprawling bureaucracy. The spark came from Germany, where the government rolled back agricultural diesel subsidies. If that sounds familiar, that's because in 2018, it was a seemingly innocuous fuel tax that unleashed the Gilets jaunes across France. France is the biggest agricultural producer in Europe, worth about 100 billion euros every year, but still imports about 50% of its fruits and vegetables. In Germany, agriculture employs less than 1 million people, but it accounts for more than half of the nation's land use. Across the board, though, in GDP terms, agriculture is minuscule. But in very real terms, what is more important than feeding your population? Plus, issues from climate change to the war in Ukraine have highlighted the importance of local food security. In Germany, a partial backtrack by the government wasn't enough. Nor in France. Even the EU has had to flinch. What makes it even harder for politicians is the overwhelming support for farmers by the broader population. Agriculture benefits from huge subsidies. About a third of the whole EU budget goes to farmers, to the tune of about 55 billion euros in 2021. Plus, German farmers enjoyed record-breaking revenue last year. But when you speak to them, it's not just about money. There's also an impression. An impression that lofty climate and trade goals are being issued by lawmakers far from the soil that grows the food that sustains them, and an impression which anti-establishment politicians hope to harvest in a year rich with elections.
Well, that was Bloomberg's Oliver Crook. Now, joining us for more on the story is Bloomberg's Lubov Pernina in Brussels. Lubov, so good to speak to you. So why are farmers protesting? What are the main reasons?
Well, there are different reasons which are particular to each country where we see farmers protest. For example, if we take Germany, its plans to cut diesel subsidies. If we take the Netherlands, these are plans to curb nitrogen pollution. And most recently, last Friday, Polish farmers announced a 1 month-long protest, and they are protesting what they say is an uncontrolled influx of Ukrainian grain, Ukrainian agriculture products. But there are obviously reasons that work for all other farmers as well. And what are they? These are increasing production costs, increasing administrative burden, also increasing legislation Europe-wide, which is becoming more stringent, and farmers see that it is really complicating their life. And also competition from other countries which happen to be thousands of miles away from European Union, yet their products come over at a cheaper price, and they probably don't have to go through the same stringent check procedures than in Europe. And more general, what farmers have been mentioned is their lack of acknowledgement, the lack of respect for the work that they do. And acknowledgement and respect is actually something that European leaders have been mentioning quite a lot recently as they're trying to address this growing discontent in the year of elections across the world.
So, Lubov, what does this mean for the elections in many countries this year?
Well, we have a very packed election schedule this year with 40 countries that account for 41% of world population and 42% of GDP. And when we look at numbers, when it comes to farming, it accounts to less than 2% of GDP in Europe or 1% in the US. And in terms of workforce in Europe, it's just over 4%. Not much, would you say, but then when you see hundreds of tractors blocking highways across Europe, it's very visible, and people notice, and people support farmers, and leaders simply can't ignore this. They have to react, and they have been reacting in different countries, rolling back legislations and their proposals, something that we've seen in France, for example, promises of more financial support and more checks on products coming from third countries. And there are some opposition leaders who want to harness this process.
Lubov, thank you so much for a great recap on some of the challenges ahead, Lubov Pernina. Now, very quickly, let's also look at what Man United is doing pre-market after Jim Ratcliffe extended his previously announced tender offer to buy up to 13.2 million Manchester United shares to the end of February 16th. Of course, Bloomberg continues with a full roundup of market news. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
After 10 years, Joko Widodo is wrapping up a hugely popular tenure as president, and Indonesia will have its first three-way election in 20 years. Will Indonesia continue along Jokowi's path of free and active foreign policy, or will his successor lead the country in a new direction? Keep it tuned to Bloomberg for live coverage from Jakarta and all the results and analysis you need. Indonesia Decides. Coverage starts Wednesday right here on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Some Fed officials say they're looking for broader disinflation to signal rate cuts. The latest CPI report due at 8:30 a.m. Eastern.
Stocks struggle ahead of that key data as the tech rally loses steam this morning. ARM surged 29% yesterday, while NVIDIA briefly surpassed Amazon in market value.
And apart from the CPI, there's earnings to provide more clues on the health of the economy. Coca-Cola, Airbnb, Lyft, Spotify, Robinhood are just amongst some of those set to report today. But we've got a little bit of breaking news, Danny, on the ZEW coming in across the Bloomberg terminal. We'll bring you those details in just a moment. Of course, it is about the inflation expectations and the outlook.
Yeah, it certainly is. I know you have that Citi note saying that they expect hikes after cuts akin to 98. I know you have the top of the charts on 98, Manus. I've seen your notes. We have.
Listen, we'll come back to those breaking news headlines on the ZEW in just a moment, because it's going to set the tone and the tenor really for the sentiment in Europe. You're going to take it away, because we're just in one of those moments of where the tailwind is turning into a headwind for me. So we're going to kick it off first up with some of the cross assets.
We are, because we're in a moment of kind of wait and see at this moment, Manus. We also might have to wait and see whether I have a market board, but let's try it out. Let's see what happens.
We'll give it a go.
We'll give it a go. So it's a wait and see moment at this time, because essentially we're going to be getting that CPI data coming out later in the day, 8:30 a.m. Manus. And we're going to get that out. And at the moment, yields are pretty steady because we've had this shift in narrative, essentially exuberance about rate cuts, to saying maybe we're going to have no landing, and because of that, we can't price as many in.
But then this goes back to the broadening of the disinflation narrative, which is from goods disinflation, which we've had. Does that transfer into services disinflation, which is a lot of what the Fed speak was about yesterday?
Yes.
And of course, we've had the 1 year, 3 year, and 5 year inflation expectations, and they've rolled down. And this is what essentially we were both looking at this morning when we came in.
Yes, it is exactly what we were looking at, but there are plenty of those who are skeptical whether we can believe that exuberance of inflation coming in. One of them is Freya Beamish of TS Lombard, who is weighing in ahead of the CPI print. Manus, she wrote, markets were hasty to abandon longer-term inflation expectations. So Freya, have we all just gone ahead of ourselves here?
Look, I think there's still this kind of mirage of inflation remaining lower, and the mirage is going on for quite a long time. And I think actually, to be honest, it will probably extend a bit further into this year. So what we're looking for this year is stabilization in the CPI inflation. When we were talking about sort of the longer term inflation expectations, this is going to be a battle that we're going to be talking about for years and years and years. And what we're saying is essentially we think that people that are on the side of the market that shifts towards higher inflation expectations for the sort of the post-COVID cycle, that they're going to be the ones that ultimately are proven right. But in the meantime, we're not quite at this stage looking for something that would be so threatening to the Fed that they wouldn't be able to cut rates in this year. So essentially the key point here, and this is a point where the Fed is in a very different situation from Europe, the key point is that the Fed believes that growth is very much supply-led at this stage in the game. So even though we see the prospect for US growth remaining resilient, and growth has been so resilient, that's not immediately threatening to a pickup in inflation over the kind of the near term, because it's about supply rebuilding. And that's the key kind of difference between the sort of the Fed and the ECB and the Bank of England kind of going forwards.
Freya, good morning. You're right, and you make this very clear distinction. I just wondered to what extent do you lean into the fact that we're moving into a new paradigm of whether the US economy can hum, drum, and remain robust? I know we're showing the CPI figures at the moment, but let's talk about growth, because there's various papers that have come into our inbox. Alfonso Peccatiello, in particular, who says we don't need to go back to 2% rates. In actual fact, the new normal is probably somewhere a higher resting rate at around the 3s, the 3.5s. Would you concur with that?
Yeah, I believe in that. I think we're in a situation where the paradigm of the 2010s is broken. What was driving in the 2010s was a lack of drivers, if you like, in the 2010s. There was deleveraging, there was hyperglobalization, and there was a very poor policy mix from the perspective of the real economy. Looking towards the future, there's the prospect, I think, for higher wage growth, which is threatening to the index as a whole over that longer term horizon. But what it therefore means is that investors have to get more exposure to the parts of the real economy that do well when there's income-led growth, when there's a bit of re-leveraging, and when businesses are investing in order to kind of push back against that wage growth. So it's like textbooks, economic textbooks will suddenly make sense again as we move out of that kind of era of hyperglobalization.
There's professors out there, Freya, who are sighing a breath of relief because they've probably had to burn a lot of their textbooks. We don't burn books here, you know, throw them off to the side. Freya, you write the ECB and BOE have missed the boat on cutting and halting QT already. What do you mean by that?
Yeah, so this is what I was alluding to earlier, that the way I look at it actually, and this is where the textbooks will have to maybe throw them out again, because where we are in the cycle right now is a place where the US velocity is still below trend. And velocity, I just mean the turnover of money in the economy. It's a measure of, if you like, over the cycle, kind of animal spirits. And what that's telling me is that there's still a lot of money in the US economy versus how much money is actually kind of needed to sustain purchasing on goods and services in the real economy. So there's still, despite the fact that QT is ongoing, despite the fact that interest rates are so high, there's still the prospect for money to sort of turn over more rapidly to counterbalance the fact that money is being withdrawn from the system and the inflow of credit is less rapid than you would expect. For growth to remain resilient. So that kind of potential for growth, for velocity to return to trend is what's behind the continuing resilience in the US economy. Whereas in Europe, QT has proceeded at such a rate, interest rates are so high and credit has pulled back so rapidly that we're actually already at trend with regards to velocity. But nobody knows where the new trend is going to be, and that could change, going back to the conversation we were having earlier with regards to what's really fundamentally changing. But cyclically speaking, velocity and the turnover of money already looks stretched in Europe. And so
this is where you would say, Freya, this would be your point, is that the velocity of money in the US had signaled a recession, but it remained elusive. And you talk about this dashboard in Europe being solidly red with liquidity trends being highly worrying, to which then that draws me if you say we're solidly in the red, liquidity trends are highly worrying, fiscal and monetary are dooming growth for this year, then we are in active policy error by the ECB now, and presumably you'd be calling for a lot more aggressive cuts than what the market has been brought back towards.
Yeah, so there's the normative and there's the what actually will come through. So where markets were at the beginning of this year, you know, that looked right to me in terms of what should happen to preserve kind of growth trends, and the pushback against that from policymakers has been, no, we're not going in the ECB, we're not going until June. Some of the data coming through now, Bailey kind of worrying that trying to push back against market expectations for cuts. If you put those things together, the result, I think, is that essentially they've delayed for too long, and therefore when rates do start to be cut, they'll have to be cut much more rapidly than policymakers are currently expecting.
If you think about the UK, for example, if they're going to have to cut really rapidly, are they going to get in a situation? I mean, I know we'd love to talk about the pound as an emerging currency, but we were speaking about this yesterday with Stephen Gallo, the idea that they're going to be caught between a rock and a hard place about cutting rapidly, but also defending their currency. Do you foresee that, too, being an issue?
Yeah, from their paradigm, from their way of thinking about things, then yes, because that's how they think. To me, it's not. It's a losing battle to try to think about this through the prism of the currency. Yes, if the currency is depreciating quickly, it's going to inject more inflation. But there's kind of cost push inflation and there's demand led inflation, and I think that the Bank of England is far too worried about that cost push inflation feeding through into expectations. And that somehow becoming this kind of self-fulfilling prophecy. In actual fact, what they should be worried about is that their own prophecy of supply-side deterioration in the UK, which they're very worried about, that becomes self-fulfilling. Because if they're destroying demand and trying to bring demand back down to some kind of notion of where they think supply is, they're actually preventing businesses from investing. They're preventing people from getting back into the labor market because the demand isn't there to rebuild supply. So if you take that in the context of sterling, essentially their battle to maintain a kind of a level under sterling is going to become self-defeating because growth won't be able to hold up to it.
Okay, well, the wages number came in at, 6.2%, which was a little bit ahead of what the estimates were, but certainly showed a moderation from the 6.7%. Again, just reinforcing perhaps the strength that we're underestimating on the supply side as far as the wages are concerned. Fred, thank you very much. Fred Beamish of TS Lombard, our guest this morning, setting the agenda on the CPI day. Other stories trending on your Bloomberg terminal this Tuesday morning. A chunk of the vast fleet of tankers that Russia uses to deliver its crude oil is grinding to a halt under the weight of US sanctions. Bloomberg tracking shows that about half of the 50 tankers sanctioned for carrying Russian crude haven't loaded oil since October the 10th.
President Biden says he's pushing for a 6-week pause in fighting between Israel and Hamas to allow for the release of hostages, saying those conditions could lay the groundwork for broader peace. Biden spoke after meeting with the King of Jordan at the White House.
As the King and I discussed today, the United States is working on a hostage deal between Israel and Hamas, which would bring an immediate and sustained period of calm to Gaza for at least 6 weeks.
And a winter storm expected to dump about 8 inches of snow on New York City today. That forecast has led school closures, warnings against road travel, and possible disruptions of flights. But we got here, and that's the main thing.
It wasn't even snow this morning. Look at that picture. That's more of a foggy, sleety rain, I'd say.
I came prepared.
You did. Manus Cranny wore snow boots and a big jacket in. I've never been more jealous of an outfit in my life. It was very fashionable.
It was completely unnecessary at 3:15 this morning.
You're going to need it later today. Okay, Manus, coming up, a jump for JetBlue. Investor Carl Icahn discloses a big stake in the company and discusses the possibility of being on the board.
And said he's warning against Mag 7. We speak to Steve Whiting later this hour. This is Bloomberg.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's Bloomberg Brief. I'm Manus Cranny with Danny Berger in New York. So the Coca-Cola earnings are coming down before the bell, and the analysts are optimistic about highlighting strong sales for the fourth quarter. Let's get to our consumer reporter, Dasha Afanasieva, with the outlook. So Pepsi have delivered theirs. Will Coke beat Pepsi is the question.
I think the expectation is that it will, because what Coke's been doing is actually increasing prices less than Pepsi. So analysts expect higher growth. And also, I think Pepsi has a lot more food, and food is arguably more susceptible to trading down, particularly to supermarket brands. So the expectation is, again, that Coke will beat Pepsi and retain that valuation discount that it is known for.
Pepsi, there does seem to be some optimism around. Citi upgraded Pepsi, for example. It almost touched Coke's market cap last year. I can't help but wonder, Dasha, I mean, are these companies talking about the Ozempic effect? I mean, who wants
I knew she'd get it in.
I had to.
I knew she'd get Ozempic into this conversation.
Well, I mean,
that's what Diet Coke's for. That's what Diet Coke's for.
But I mean, there's that story, right, from the CEO of Novo Nordisk saying companies are reaching out to him worried. I mean, Dasha, how likely is it that Coke and Pepsi are some of those companies who are concerned?
Absolutely. I think this is one of the key things that investors will be looking for later on, is an update on what is Coke's strategy in dealing with GLP-1 drugs. I think it would like to say that it's part of this longer-term transition to low calorie and no calorie. But I think that ideally investors want some kind of robust strategy for dealing with it, and maybe even an explanation of where there could be opportunities, more detail on how they expect these drugs to affect the business. And I just wanted to mention one other thing that I'll be looking out for, and that's the boycott in the Middle East and whether that's had an impact. Because earlier on last week, Unilever said that it's actually hit sales in Indonesia, which is a Muslim majority country. So I'll be curious for Coke, which has both bottling in Israel and in Palestine, what will the impact be?
Yeah, because we saw comments from Starbucks too. I'm just dreading the day that we're going to see like Coca-Cola plus protein plus vitamins or whatever crazy thing they're going to come up with to combat the Ozempic effect. Dasha, thank you so much for joining us. That's Bloomberg's Dasha Afanasieva. All right, to shares of JetBlue, they're jumping in the pre-market trade. Carl Icahn has disclosed a 9.91% stake in the airline, and he's in talks about the possibility of being on the board. JetBlue writing in a statement, "We are always open to constructive dialogue with our investors as we continue to execute our plan to enhance value for all of our shareholders and stakeholders." Let's get to Bloomberg's aviation reporter, Sid Phillips. I mean, Sid, it's been quite the saga over the past few months for JetBlue, considering the scrapped Spirit deal. So why is Icahn taking a stake now?
Yeah, so Icahn's taking a stake now because he thinks that the stock is undervalued. In the last 12 months, the stock's fallen about 30% as it's sort of dealt with its regulatory issues.
Sid, good morning. It's Manus. So the question will be, what scale of board representation does he get? And also, he's got form. I didn't realize this. He took TWA private in the 1980s. I mean, it went on to have its own problems. So he has got some interest in airlines, but perhaps not success.
Yeah, I mean, I think, JetBlue is a really interesting story. I mean, JetBlue tried to expand its business first by agreeing to a Northeast alliance with American Airlines. That was shut down because of antitrust concerns. And then they tried to take over Spirit Airlines, which again was shut down for antitrust issues. So JetBlue is an interesting story. It's not one of the big four carriers in the US, but it does have ambitious growth plans. And it'll be interesting to see how ICANN sort of adapts those growth plans to his sort of thinking, really.
What are those growth plans? I mean, if they've lost their hopes of being as big via merger with Spirit, how does JetBlue get there, Sid?
Yeah, so JetBlue is now sort of talking about, while they will appeal the decision on the Spirit Airlines merger being blocked, they're also sort of working on plans sort of for a profitable, to be standalone and profitable. And that includes sort of looking at their route network again, slowing the pace of deliveries of new aircraft, as well as sort of working to shore up their margins and basically cut costs.
Okay, Sid, thank you very much. We'll keep an eye on what happens next with Carl Icahn's portion of JetBlue. Quick snapshot of bonds. It is CPI day, so we're counting down to the core CPI. What will we get is the question for markets. On the headline, Danny, we're looking for 3.7%. On the core, I should say, year on year, at 3.7%. There you go. You've got 10-year government bond yields ticking down ever so slightly. But we were looking at the gilts. And again, the wages coming in just a little bit hotter than the estimate on the gilts. Yields rise ever so slightly, up 2 bips.
Yeah, not that big of a move. Fun fact for you, U.S. yield curve exactly 1 month away from its longest inversion on record.
And yet it's powering ahead. Wages are strong. Jobs are strong. What happened to the theory that an inverted yield curve is tough times for the economy? We'll see. Okay, big day for the bond markets. We'll take you through that in just a moment, right here on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg Brief. I'm Manus Cranny with Danny Berger alongside me in New York. So he left Nike. Talking about Tiger Woods, of course. Tiger Woods left Nike, and he has gone, now you'll like this, because it's going to be a whole new apparel wear for her. She's bought the clubs.
Yes.
Golf clubs, that is.
Correct.
And he's going to launch a whole new line of sports apparel.
Yep, he's partnering with TaylorMade. So I bought golf clubs. I couldn't afford TaylorMade golf clubs.
This is an expensive sport that you've chosen.
It is. I don't know why I've done this to myself, but it set you back, at least a couple grand. I myself bought used Wilson golf clubs. But yeah, so he's making a new clothing line. I love what he said during the event.
Yeah.
He said, it won't help you hit further, but you look better than you do right now.
Well, now you know how to hit the ball further. It's like, be there. It's got the head down.
Yeah.
Okay, you just got to have the head down at all times. As you go through the swing, just keep the head down.
Yeah.
Okay,
You sound like my golf coach.
No, my father was my golf coach, and it was the bane of his life to sort of keep your head down and keep the swing. But I mean, if you look good, what more do you want?
That's true. That's my motto on the golf course. I'm like, yeah, I hit it, a couple inches, but I got all the right swag, so that's all that matters.
Is he going to make sense? What was it? He made $600 million over the lifetime with Nike, so it's going to be interesting to see. This is an endorsement deal where the athlete comes in, you build a brand, and you hope things go well. So it's not that. This isn't that. This is a full-on, unequivocal, committed partnership. It's a bit like Bloomberg Brief. We make every decision together. This is the personification of harmony.
No swag, though. No swag. But look, Taylor's deal with Nike was one of the most lucrative in sports history. But it helped both sides. It helped Tiger, and it helped Nike. TaylorMade maybe doesn't need help in golf specifically, but if this gets to a wider audience, a partnership made in heaven. Again, like Bloomberg Brief.
Yeah, that's why we have Rory McIlroy to take over from Tiger Woods. Now, did you ring in sick on the day after your Super Bowl? There's 123 million of you out there. You set a record in terms of viewing, according to CBS.
Yeah,
We're here.
Yeah, we have video evidence that we did not have the flu, but yeah, so it was a record audience, 7% increase from last year. I love that not only did they do it on CBS Network, Paramount Plus, but it also aired on Nickelodeon.
Yeah, I mean, this is the edification of appointment viewing.
Yeah.
Pay to view and turn up for it. There's Paramount Global up 4% yesterday. So this was a pretty powerful demonstration. And I mean, the traffic on a lot of social networks was up as well. The number of posts on X on the game was up 26%.
Well, Roger Goodell is already talking about having another Super Bowl in Vegas. He's saying, oh, you've been great host, and Vegas wants to be a sports center. Maybe we'll get some next time.
You'll take me to Vegas.
Manus, yeah. I can't afford nice golf clubs, let alone Vegas.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger. Here's what you need to know.
Some Fed officials say they're looking for broader disinflation to signal rate cuts. The latest CPI report hits the tape at 8:30 Eastern.
Stocks struggle ahead of that key data. The tech rally loses steam this morning. ARM surged 29% yesterday, while NVIDIA briefly surpassed Amazon in market value.
And apart from the CPI, there's a host of earnings providing more clues on the health of the economy. Coca-Cola, Airbnb, Lyft are amongst those reporting results today.
And there's so much to celebrate. A Super Bowl, a Lunar New Year. And
NVIDIA worth more than Amazon.
And CPI Day. It's the most holy holiday here on Bloomberg TV of them all. Let me show you what markets are doing ahead of that, because there's not a lot of movement.
Holy CPI Day.
Yeah, holy CPI Day to happy CPI Day to all those who celebrate. So not a lot of movement on the 10-year. It has been this reshift in narrative from exuberance of rate cuts to saying maybe this economy is headed for a no landing and we need to pull back on this. I told Manus this earlier, my fun fact of the day. Should yields stay about where they are for a month, it will be the longest stretch of yield curve inversion on record. Does hotter data keep coming in potentially mean we finally get a re-steepening of the curve? We also had UK wage data coming in at 6.2%. The expectation was 6%. At first, we did see a big move higher in yields, something like 4.5%. We basically have halved that, just showing the lack of reaction in this UK market. And finally, Manus, we have a nice little milestone to celebrate. It's not only the S&P going to 5,000, it's $50,000 for Bitcoin. We finally got there again. That is the first time we got there since December 2021, supported by all that money sloshing around in the ETFs.
That sneaked in there, didn't it?
It did.
50,000 just bang. Now, it was 1987. It was Valentine's Day, and there was a band called Bon Jovi, and they were singing Living on a Prayer. It was #1. I bring that up, A, because we're close to Valentine's Day, and also the question for these markets, how rarefied is the air? How much of a living on a prayer are we? Earnings are growing. They beat on the quarterly estimates, but of course, they tanked the estimates before we went into that. The question is, how much air comes out of the tire? The CPI will define the next narrative in the bond market, which has incrementally crept up because the bond market is hanging on to this view that they want better qualification and clarification on the inflation narrative. When it comes to the US equity market, you're trading on 20 times earnings. We've only seen that twice before, in the dot-com boom bust and post-pandemic. NASDAQ gives back 0.5% this morning. ARM just flew higher yesterday. That has tripled since its IPO, up 29% yesterday. And then JetBlue, of course, Carl Icahn taking that portion, 9% of the company. So you're looking at JetBlue up 14%. But wow, that was what you call a stunning performance. And then when it comes to Asia, keep an eye on this. Chips equipment maker Tokyo Electron. This is the close, obviously. Japan is now closed, but the Asian session still powers ahead. And that tech side up 13%. Of course, SoftBank flew higher on the back of ARM. Danny.
Will be interesting to see if the CPI supports that narrative or does not. Maybe lower inflation is good news for tech. But Manus, we did get the New York Fed inflation expectations yesterday. For the medium term, the 5-year outlook, they have dropped to the 3-year inflation outlook, rather. That's the blue there, dropping to the lowest level since the data had started to be collected 11 years ago at 2.3%. It does feed into that CPI that's expected to be below 3% for the first time since 2021.
Yeah, and if it comes in at 2.9%, that's going to be a good one. Look, it comes down to whether you go with this Bark and Collins narrative. They want to see this broadening of the church to services disinflation. If that follows suit from the goods disinflation that we've seen, maybe it'll adjust the rates trajectory as well.
Yeah.
I just showed you the NASDAQ futures. They are leading the stocks a little bit lower this morning. That's ahead of the inflation data this morning. And here's what our next guest, Steve Whiting, had to say about tech. He writes, whilst we have nothing against the Mag 7, that's good to hear, we don't think that the profits growth of 40% every year, broadening profit gains beginning in 2024, favors the equal weight S&P 500. So joining us now, it is Steve. So you have nothing against the Mag 7. That's good to hear. Okay. But is it time to throw the baby out with the bathwater, or do I hold on to a portion of Mag 7, but I incrementally go for breadth? You talk about that as being the strategy forward.
Well, when shares are at multi-trillion-dollar levels, you might as well look at these companies one by one, right? If you don't have the patience to take a look at mega caps at that level and consider what their outlook might be individually, I don't know, that's a little bit of a problem. But I think, again, when you had a 40% gain last year, you've got to respect that. You need to respect that this group of tech platform companies has grown EPS 16% per year since we could start to track them. But they had a 106% return last year. And increasing competition in the new areas that they're investing in. Their investment spending, should matter for them. The fact is that they haven't grown EPS quite as consistently as last year might suggest. So I think you have to take a look beyond. And just the good news is that we had this hidden recession in the economy. We had a decline in trade, a decline in manufacturing, a decline in property markets. And we're seeing an earlier than expected rebound in these areas of the world economy. And we're going to see profits climb much more broadly for companies this year. So some way or the other, we don't think we get to another 26% return year for the S&P 500, but I think it can be with much broader participation. A lot of companies in the mid-cap area, I think will look a lot better, and many more sectors than just the tech-related couple.
Steve, you're not the first person we've heard say this, that the recession has already happened. You say it was a hidden recession. So are we done here? Is it job done, no landing city, here we come?
Well, we had the pandemic, the collapse in the economy in 2020, and why would we need to do that again? Not if inflation is, in fact, close to the Fed's target. Now, does that give the economy this fantastic room to run? Can we throw unemployment down to 2%? No, we can't, right? But it really doesn't require us to have a collapse in the economy to stabilize consumer prices, that there were huge levels of discontinuity in the economy. There was upheaval. There was a real mismatch between supply and demand in that chaotic period in the economy. We don't need to pretend that this is inflation that has a life forever when it doesn't.
I mean, you talk about this, the idea, the hidden beneath the veneer of rising employment was novel. Now, you cast yourself forward. Do you think that there is still some kind of a long variable lag to come? Because the refinancing that everybody was obsessed about, both in housing, which obviously didn't materialize because you've all refinanced your houses here at 2%, not everybody, but a majority. You've also got a lot of healthy balance sheets which are well refinanced. I just wonder, is this material slowdown a 2025 story, Steve, or do we just silently pass through it?
Well, look, if we had a private sector boom, which we have not had, we had a lot of government borrowing, a lot of stimulus that's waxed and waned. If we were to suddenly have that kind of real economic boom for a couple of years, then we'd set ourselves up for recession. What I think we have now is going to be a labor market that slows down. That's
Okay.
despite the January employment data. You know, these extremes of the year where we take, a large usual decline in employment and say it's a big gain, this sort of thing I would look past a little bit. It's not nearly going to be as severe a slowdown as I once expected, but the labor market has galloped ahead in industries, services, hospitality, leisure, these areas that have a lot of headcount, a low level of productivity, a low level of automation, have been powerful employment gains since we had elements of the pandemic end.
Right.
That area of employment is slowing down. So I would expect the labor markets to slow while corporate profits, which were negative 7% ex Mag 7 last year, I would expect the profits to rebound while employment slows.
Okay.
Moderate in both directions.
Okay, so if that's the environment we're living in, you also write, Stephen, that regional banks, it's a moment of caution. I like how you put it that way. If this is a moment of caution, again, and you write how this isn't a wider systemic issue, but a reason to pause, you look at spreads on the North America credit default swap gauge that are the tightest in 2 years. If this should be a moment of caution, do you look at something like this and say, maybe it's time to hedge?
Well, look, that hedging, again, is a question. We have had a good market. Hedging costs across some markets are quite cheap. Now, what you're looking at, again, is high-grade CDS. More companies are going to have, again, rising profits. And it spreads, but it's at a high cost of capital with the rate component having a pretty high level. If you want to borrow for 10 years in your BBB company, it'll cost you $575. Maybe you'll borrow a little bit further in. So, this picture, again, is one of fairly firm credit. It's a lack of collapse, and we have some areas of weakness. If you wanted to find one area outside of government borrowing that picked up a lot, it is commercial real estate lending. It has been driven by a 40% gain in that lending since the end of 2020 for small and mid-cap banks. A lot of it is going to multifamily housing, where we have a housing shortage, not an excess. So the absorption rate for apartments, for example, is extremely strong. But there is office space, and we know that this is a problem. We're going to see a technological threat to offices. We're going to see again, lower utilization because of the way office space is being used. Now, this is very, very small compared to having the entire mortgage market really misaligned back in 2007, 2008. So will we have some credit problems somewhere? Yes. But that doesn't sort of obviate the fact that most companies have strong profitability and a very strong ability to repay their debt. And for the time being, a really modest level of required refinancing.
Stephen, I'm afraid that's all we have time for. Really great to hear from you this morning. Stay warm, stay dry from all that snow up there. That's Stephen Whiting of Citi. Coming up, building a billion-dollar beauty empire. We're going to hear from Desiree Rogers, a former White House social secretary and publishing executive. That's next here on Bloomberg Brief.
Studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. On this inflation day, we put the spotlight on a CEO who launched 2 brands during the global pandemic. Desiree Rogers is a former White House social secretary and publishing executive who's now seeking to build a billion-dollar beauty empire, rather. Manus, I sat down with her last week, and here's what she had to say about navigating a bifurcated cosmetics market.
We have both, so we get to see both. We have 2 brands, one in the mass market and then, of course, one in the prestige market. And so, you know, there's a lot of things happening, right? We see, you know, on the positive side, inflation kind of, you know, tempering out. We see interest rates, you know, we'll see what's, you know, coming down a little bit. But on the other hand, we see credit card debt, you know, at an all-time high. Auto delinquency is at an all-time high. And so what does that really mean in terms of the businesses that I represent, beauty? And I think people think of it as an affordable luxury. And so one of the questions that was asked recently is, you know, student loans, for example, and we know what's happened with that. Are you going to cut down on your purchases, you know, of beauty or pay your student loans? And one of the things that came out is that, yes, there will be somewhat of a downturn in my expenditures, but maybe I will move the opposite. I'll move from a more prestige brand to something that's more of a mass brand. And so I'll have to make that hard choice as I decide my 10 items. Maybe not all of them will be prestige, some of them will be mass.
Oh, so it's a down trading.
Yes, exactly.
It's so interesting because you bought both Black Opal and Fashion Fair months before the pandemic really started to kick off.
Unfortunately, yes.
Well, what has that experience taught you and how to do that sort of mix of different brands? If people are trading down, how do you change the sorts of products that you're offering?
Well, a couple of things. First of all, our businesses are really in the BIPOC space, so multicultural space. And many brands, you know, have introduced 1,000 shades. But I'll tell you, when I go up to that counter for those 1,000 shades, I still can't find my color. So we like to think of ourselves as really undertone experts in that part of the market. I think one of the things that we saw as the pandemic was happening is we just hunkered down. We just said, look, we just bought these companies. We got to get ready because it's going to turn around at some point. And so we really just focused and hunkered down on building the business. Because remember, we bought one out of bankruptcy. And so it really was the name only. So we really had to create all of the products from scratch. And we also had to think about distribution. So one of the things we really worked on were the product offering and then also making certain that we had what we thought was the perfect distribution across the 2 brands. And that distribution is very different. Black Opal is at Ulta, which I like to think of as maybe the mutual fund of all beauty because you have mass and prestige. And women are buying both. I mean, that's the key. No one is just buying one brand anymore.
You talk about how you bought the brand and you had to revamp it. I know part of what you've done, you've introduced non-cruelty, vegan products, more research, but of course with that comes more spend. How much are you able to pass that on to the consumer right now?
It's interesting that you asked that. You know, raw materials certainly have been going up. We've seen them temper a bit, but manufacturing and logistics have gone up. And so we have one opportunity a year with our retailers to increase pricing. And so pricing has been tricky. I mean, we really are paying attention to, you know, how can we predict for 1 year, you know, what the pricing should be, and then also not having to go up by double digits each year. But we have increased our pricing over the last 2 years, but we think it's worth it.
So as you mentioned, you bought 2 by people of color brands almost 4 years ago. Desiree, you eyeing anything else?
Listen, the whole concept is, can we create a collective that is associated with this market that is growing, by the way, that, you know, maybe has multiple brands that then use smaller brands that then have a back office, and we are able to hire the best legal analysts, best finance, you know, economies of scale with warehousing, so that all of those shared services are across these amazing BIPOC brands. And so that's the idea. We have 2 now. You never know.
There's this 15% pledge, which I know you're involved in, from Bluemercury and Sephora, basically saying 15% of our shelves, that's the goal, to be stocked with Black-owned businesses. You talked about the need of needing to manufacture, needing to ramp up. It's one thing to get actually on the shelves, but how difficult it is for minority businesses, which historically have been underfunded, to get to a point where they can actually be in a Sephora.
Let's talk about that funding. I mean, first of all, you know, all of beauty, it's only 2.5% are purchases that are coming to Black-owned companies, and that includes companies that have been acquired by the big boys, like a L'Oreal. And so that pot is pretty small, even though Black Americans spend over $11 billion. You know, and so there's a couple of things. One of the things that was analyzed in the McKinsey study is if we can have the Black consumer feel comfortable that as they come into a retailer, they're going to understand their skin, their hair, their needs, then there's about $2.6 billion to unlock there.
Desiree Rogers there, the CEO of Black Opal. Manus, a few things stood out in the conversation to me. One was just underfunding of minority-led companies, especially in the beauty space, which makes it harder to get into the big shop stores. But the other thing, and especially relevant on CPI Day, is that unlike the handbags of the world, if you want a Hermes, you're going to buy a Hermes. But with cosmetics, she talked about that she is seeing folks trade down, that when you're worried about inflation, you don't go and buy the priciest of cosmetics.
And yet she had a wry smile when she just said she's still been able to put price rises through over the past 2 years. But then, of course, that's because her view was it's worth it. It's interesting when you listen to her talking about building a collective. And it reminds me of a day that I spent with Paul Smith, the British designer in Italy. He takes open space in his atelier in Italy. And she's talking about giving small brands, which are starting out, time, space, operations, marketing, accounting. And that is absolutely the philosophy of Paul Smith with young designers through the London Fashion Week.
Well, she did that in a way with the 2 brands she bought, Black Opal and Fashion Fair. These are very important historic brands specifically focused on people of color that had gone into bankruptcy. She bought them in large part just for the name, but to make sure that there was still a place for them and that you can still go and get them. And they've been doing very successfully since she took them over.
And it is about partnership because she's got it in Sephora and in Macy's for fashion fairs. That's the retail partners for them. And then there's the sort of the broader church in Target, Walmart, and CVS on Black Opals, the retail partners. So it's about who you partner in this business with as well. Brilliant. Well done. Great interview. Great conversation. And a very elegant lady with the money and the business nice. Let's talk about oil and gas because it's never far. We've had the IEA report out this morning. We're powering ahead this morning. Crude is up 1.1%. I think there's a couple of things here. One, you've got these sanctions finally kicking in terms of Russian float that's out there, but also the IEA comfortable with the markets, moderate price increases in 2024. Demand will rise, Danny, by 1.2 to 1.3 million barrels a day. And of course, it's a source of angst between OPEC and the IEA. OPEC Plus is showing good discipline. I'm sure they'll be happy at the OPEC Plus headquarters when they read the IEA synopsis. But oil is powering ahead this morning, Danny.
And well, we get the OPEC report soon, don't we?
We do indeed. Let's see what they. Well, it's all about the battle of the data, isn't it? The robustness of the data.
Well, we're going to have a preview of some of the data to come. Coming up, we'll set you up for your trading day.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Danny Berger with Manus Cranny in New York. Manus, it's CPI day. It's going to come.
I didn't know that.
Did you not know that? Did I not tell you enough times? 8:30 a.m. That's when the data is hit. We're expecting.
And if it comes in at 2.9%, that'll be the first time since?
March 2021. That
she
it's
did
come
well because I
under
probably
3%.
wouldn't remember.
I hope
first
that's
time
right.
Since, yes, if it comes in at 2.9%,
Yeah.
sub 3%, it'd be the first time since 2020. Well done.
Thank you.
First time since 2021.
Gold
I
star.
wouldn't have remembered without my notes.
Oh, goodness. Anyway, Manus, you got a little bit of sports news for us.
Yeah,
A little bit
there's a
footy.
little bit more on the football side. You got Manchester United. Their shares are rising this morning because, Danny, we got the billionaire Jim Ratcliffe extending his offer to purchase the 25% stake in the club until the end of this week. So there's an extension on that for him. You've also got JetBlue jumping. Carl Icahn disclosing his 9.91% stake. Will he get board seats? What representation will he get? And then, of course, ARM. I mean, this has tripled since their IPO. It gives a little bit back this morning. We were up 29%, to be fair, yesterday.
Yeah, I mean, good day for them. Good day for NVIDIA, which at one point surpassed Amazon in market cap. Also, bad day for the Swissy. I think we have the dollar Swissy. We had a surprise drop in inflation coming from Switzerland, easing unexpected, and it does open the door to a larger rate cut from the S&B, a sooner rate cut, I should say, from the S&B.
Well, look, it's like layers in the cake, isn't it? There's the pop in terms of dollar Swiss. CPI came in at 1.3% from a year earlier. That's way under the 1.7%.
Yeah.
But of course, you had the wages in the UK coming in a little bit hotter than estimated.
Yeah, 6.2%. Estimate was 6. Do we get a repeat of hotter than expected data here in the U.S.? We'll find out in a few hours.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat. biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The inflation problem is not going away. That will continue to create more and more risk of financial stability issues down the road.
I do see risks building that, could perhaps jeopardize this smooth disinflation.
Basically, every single investor pricing in a soft landing, which again gets me quite nervous.
All we need is a tiny whiff of less dovish data, and it, I think, would already be enough to send a bit of pain across all the asset classes.
If we were to get an upside surprise on CPI, then folks might say, wait a second, is this thing really overheating?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
It is CPI Tuesday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market inching lower. We're negative by 0.4% on the S&P 500. Typically, we start this program by talking about inflation, but you don't want to miss the Bramo rant on schools in New York City. Mayor Adams, Eric Adams, saying we're strongly encouraging New Yorkers, if you don't have to go out, stay home. Stay safe, New Yorkers. We're looking for up to 8 inches of snow dumped on New York City this morning. In the tri-state area, it is wet and windy. Parts of New Jersey, Pennsylvania could see as much as 12 inches. Public schools in New York City.
How long are you going to do this for?
I'm going to keep on going.
Keep going.
They're closed, apparently. Remote learning.
Yes.
Bramo, thoughts?
I just, honestly, it's like adding insult to injury. As a parent, first of all, having your kids home is a pain in the neck because you have to figure out where you're going to put them, how you're going to deal with them, what is going to be the opportunities for the day, for getting outside, etc. But then to have to oversee them and they're learning and get on their case for not doing their homework assignments while they're looking out the window, hoping to go sledding and feeling caged in and arguing with each other. It's just too much.
When you were told yesterday evening, as far as they're concerned, do they believe it's a snow day or do they think they have to learn something today?
They think that they've got 10 minutes of logging on, taking attendance, and then they can go outside. I assume that they also have work that they have to get done, and I assume that as the parent, I'm supposed to oversee it. I just think either you give a snow day or you don't. This sort of half-half makes it just more of a burden for the parents.
We can recap both Lisa's thoughts throughout the program and get you real updates from Danny Berger every 15 minutes, every 30 minutes on this show. We'll catch up with Danny a little bit later this morning to get you all an update. Stay safe out there, of course, if you are commuting this morning. Let's turn to the inflation data. CPI numbers, this is what we're looking for. We are looking for a 2-handle on CPI year over year. On the headline read, 2.9% is the estimate, 3.4% is the previous read. Strip out food and energy, we're looking for something, Lisa, closer to 4%.
Yeah, and basically what you're looking at is year over year going in below 3% for the first time going back to 2021. Here's what I'm watching. The actual components. The broadening out, because that seems to be the key phrase for a lot of Fed officials, whether it's Barkin or whether it's Boston Fed President Susan Collins. But the idea here is is it just products? Is it just food and energy? Or is there something further under the hood that can give the Fed confidence?
And what is the risk that we stabilise north of the 2% inflation target of the Federal Reserve? That number drops at 8:30 Eastern time, and then the political spin is going to begin. And I would argue the political spin already started right before the Super Bowl when the president released a video, Anne-Marie, talking about shrinkflation.
The president released a video from his campaign account. The White House released a video. And yesterday, the president, at a speaking engagement, went after corporations yet again, calling it greedflation and shrinkflation. He's not mentioning brands by names, although he did recently mention Snickers, which the president was actually wrong, and the fact that the Snickers bar did not shrink. But this is a way that the White House is likely going to try to massage this message. But every time we do get in the CPI report, he does come out and says more work needs to be done, although Treasury Secretary Janet Yellen seems to want to call victory on this soft landing.
This is the standard of the conversation, Lisa, down in Washington, D.C.
What, they were talking about Snickers bars?
Basically.
I mean, and then on one hand, we're talking about how the Snickers bars aren't big enough. On the other hand, we're talking about how to get Ozempic shots. I mean, put it all together. But here's the question. Ultimately, how do you message something that is good progress, but people still feeling the two-year cumulative inflation? It's going to be tricky. The key is to talk about where progress needs to happen and talk about it in a granularity and treat people like they're smart and they actually understand what they're talking about.
Just a note on policy and not politics. There is a bill working its way through the Senate, believe it or not, at 6 a.m. in the morning down in Washington, D.C. You told me a little bit earlier this morning they've turned up in gym clothes.
Some of them.
Athleisure.
Not
Athleisure
everyone.
on Capitol Hill, apparently, to try and pass this foreign aid bill.
Well, some of them are being woken up to get back to the Senate floor to vote on this, and it looks like they have the numbers, but the vote is still open at the moment. They will be passing $95 billion in the Senate for Israel, Taiwan, and, of course, Ukraine. The issue is, last night, before I went to bed, the last thing I read was Speaker Johnson, a statement from him saying basically this isn't going to happen in the House. In the absence of having received any single border policy change from the Senate, the House will have to continue to work on its own will on these important matters.
So I ran about schools and you ran about what these senators wear. You're the sartorial critic of the Senate.
I was just curious, that's all. This is what AMH told me. It was the first thing Anne-Marie told me a little bit earlier this morning. I think it's disrespectful to the office. No, it doesn't matter. Equity futures on the S&P 500 look like this. We're negative by 0.4%. In the bond market going into CPI a little bit later this morning, down about a basis point, 416.96 on a US 10-year. Coming up this hour, Chris Verone of Strategas with stocks a little softer ahead of today's CPI report. Norman Rule, former senior US intelligence official, as Biden calls for a 6-week pause in the Israel-Hamas war. And Jennifer Lee of BMO as investors look for an inflation read below 3%. We begin with our top story, the equity rally cooling ahead of this morning's CPI print. Chris Verone of Strategas saying even if we get a pullback in equities, the floor is high. Writing, quote, if the market is to consolidate, expect it to be contained. Trends remain overwhelmingly positive for a 50-day support on the S&P 500 at roughly 4770 and longer-term worst-case 4600. Chris Verone of Strategas, a bad company, joins us now for more. Chris, it's great to catch up. We got the Bank of America Fund Manager Survey a little bit early this morning. I'm going to go through the most crowded trades for you. Long Magnificent 7, 61% of respondents. Short China, long Japan, long cash. Long cash, by the way, is only 2%, but overwhelmingly long the Mag 7. Chris, when you look at things, how one-sided, how concentrated are some of the action that you've seen over the last month or so?
Well, I think it's certainly one-sided in terms of the leadership, but this idea that it's just 7 stocks working against the entire market, I think is a little misleading. I mean, you have the small caps breaking out right now. You have the equal weight S&P making 2-year highs. Now, I recognize these things have not been leadership, but really what has? It's been a very high bar to outperform the top of the market. But the good news is the other stuff, the other 490 stocks, the equal weight, the small caps, they aren't going down in price. So when you look at the health of the market, I think you still have to argue it's pretty broad. It's well participated here. You could certainly get some type of a seasonal or sentiment-induced pullback here. But as we wrote yesterday to clients, I think maybe 4,600, 4,650 would be kind of worst case in terms of any seasonal weakness here.
Chris, when we spoke to you closer to the start of the year, you were talking up financials and the performance of financials coming into 2024. What's the state of play now after that, I would say, speed bump, sort of hiccup with NYCB just a few weeks ago?
You know, it's remarkable, John, how quickly people want to kind of go back to the imagery of last February, last March, when the regional banking issues were first starting to percolate. I think it looks different this time around. Very importantly, as the banks and the regionals have sold off here the last couple of weeks, what you haven't seen at all is any stress in financial credit. That's a very big difference from a year ago when you began to see stress really permeate through the financial system, through the avenue of credit. I think the other thing you haven't seen here, unlike last year when the regionals came under some pressure, you began to see this very persistent bid for the market's more defensive corners. You saw it with staples, you saw it with utilities, and you don't have that here either. So if I'm going to evaluate kind of the correction that we've seen in the regionals or the real estate names or the banks here over the last 3 or 4 weeks, I actually look to it as quite viable. The trends are pretty positive under the surface. I think at a minimum, let's give them a little leash here to respond to this oversold condition.
So buying regionals or buying financials, just to be clear?
Both. I think we'll get some, I mean, and yesterday was a great example for some softness at the top of the market, the tech reversals. You actually saw regionals and banks in particular act very well off support. I think you'll get a very good oversold response here from those very, what I think the consensus would say are the questionable parts of the market, the regionals, the REITs. And when you look at the banks more broadly, keep in mind the capital market stocks continue to act well. Goldman Sachs made a new high yesterday. The consumer finance names continue to trade well. That's American Express and Capital One and Ally Financial. What's often perceived as one of the weaker parts of financials actually trade quite well here.
So at this point, there's sort of a test. How far bullish are people right now? To have a downside that isn't that down is fairly bullish, but then the upside being driven by small caps is next level. And I'm wondering, you're talking about how the consolidation we've seen is basically a far cry from some of the gloom and doom that people talk about. Is it enough to get in and to bet on the broadening out that has yet to happen?
Well, I think this story that the broadening out is yet to happen, frankly, Lisa, is a little misleading. I mean, we're only 6 weeks removed from some of the best breadth readings we've ever seen in 50, 60, 70 years worth of data. It was December 14th. You had more small cap stocks make a new high than you've seen in basically since the inception of the Russell 2000. And their only crime they've committed in the ensuing 6 weeks is simply consolidating that move. So I think this idea that, oh, the broadening never happened is a little bit misleading here. I think it began to happen in the fourth quarter. We've paused here, but all signs point to this re-engaging here. I thought yesterday was really interesting. Yeah, the S&P finished lower, but you actually had more stocks up on a percentage basis yesterday than the highest reading we've had all year. So I mean, internally, yesterday looked good. You had the banks respond. You had the small cap start to break out. So let's give this a little bit more leash to kind of re-expand here.
Hey, Chris, you know why? It's because the excitement is elsewhere. We're looking at stocks like ARM, which have basically doubled in 3 days and tripled since the IPO. NVIDIA's absolutely flying again, going into earnings next week. I want to talk about the consumer, Chris, with you just briefly. So we've got CPI a little bit later this morning. In a couple of days, we've got retail sales as well. When you look at staples versus discretionary, what's the signal you take from the performance at the moment?
Yeah, it's a great question, John. And, we always say we'll take the market's intuition over our own any day of the week. I think the market's the best economist that I know. And the discretionary versus staples pair is a very good barometer for how the market perceives the economy. And that made new highs yesterday. And so did transport versus utilities. And so did high beta versus low beta. So all the, let's call them risk barometers that I would look at to gauge how the market perceives the economy are still in pretty good shape. And I think interestingly, kind of you mentioned some of the stories going on abroad. I mean, you have a lot of new highs going on abroad too. You have Taiwan at new highs, you have Korea breaking out, you have German DAX and French CAC right there as well. And I think very importantly, you have the signs or maybe the early signs of some capitulation in China right now, which is interesting to us.
Most unloved equity market in the world, Chris. Do you like it enough?
Yeah, I thought peruse the FT, the New York Times, and the Wall Street Journal from the last 2 weeks. You can't find a bullish word written on that part of the world. You had 80% of the Shanghai Composite make a 52-week low last Monday, except the worst parts, financials and property stocks. Something there is changing. I think it's changing right now. I would cover your shorts. I'd look at the price action in the domestic equity market, look at the breakout in WIN, in LVS, and MGM, look at the turn in Yum China. Something's happening there, and I think at a minimum, the bears have to cover shorts.
Interesting. Chris, good to hear from you. Chris Verone,
Thank you.
a strategist on the most loved equity market on the planet right now. I'll go back over the fund manager survey from Bank of America. Bramo, I know you read the same thing. We're looking at the most crowded trades. Long Magnificent 7, that's the #1 most crowded trade. #2, short Chinese equities, right to his point.
And to Damian Sassauer's point, is it a trade? Maybe not an investment, but a trade. Something's happening there. I love that statement. Something's happening. Take a look at MGM. It's kind of, you know, you see the sort of returns picking up just a touch. It shows, though, just how risk-on people are, that they're willing to say, well, the technicals are so bad, it can't get any worse. I guess we're going to, you know, throw a few dollars into that area.
It's the one place where sentiment is really rock bottom and down B. Equity futures on the S&P, by the way, we're negative here. Near session lows, we're down about 0.4%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. New York City residents are being urged to stay home today. The city is forecast to receive up to 8 inches of snow. Mayor Eric Adams closed public schools and moved students to remote learning. Snowfall of more than the 7.3 inches in Central Park. It'd be the most since Jan 2022. Areas north and west of the city could get as much as a foot. Northern New Jersey, eastern Pennsylvania, and southern New England could see as much as 12 inches today. Former President Donald Trump has endorsed his daughter-in-law to help lead the Republican National Committee. Former television producer Laura Trump is married to his son Eric. Under the plan, she would become co-chair with the RNC's general counsel, Michael Whatley. The move would tighten Trump's grip on the party. According to sources, current chairwoman Ronna McDaniel is in discussions to step down. And Sunday's Super Bowl was one for the history books, a first back-to-back win for a team in 19 years, plus the most TV viewers ever. CBS says that 123 million people tuned in to watch the Kansas City Chiefs defeat the San Francisco 49ers in Super Bowl 58. That's a 7% increase from the previous high, which was set last year. Betting also set a record, with gamblers in Nevada wagering a record $185 million on the game. That's up 21% on last year. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. Bramo, surprised? Not really, right?
About the record? No, I think we all were expecting it. It basically is up from, what, 113 mil last year?
Yeah, about 115, something like that.
Yeah.
Taylor Swift effect, is that what we're saying?
I guess.
No.
If you want, do you really want to talk about her again?
Not really.
Okay.
I want to talk about Jim Nance.
Oh, sure.
I want to talk about Jim Nance and CBS Sports, because that guy, absolute legend. I tune in for Jim Nance of CBS Sports.
You're talking golf?
He does golf as well.
Yeah.
Yeah.
You want to talk about
Does
golf?
all sports,
basically,
Bramo.
You're basically saying, let's shift gears from the Super Bowl
to golf.
and talk about golf.
No, let's not. Up next on this program, President Biden pushing for a pause in Gaza.
The United States is working on a hostage deal between Israel and Hamas, which would bring an immediate and sustained period of calm to Gaza for at least 6 weeks.
That conversation is coming up next, live from New York City. This is Bloomberg.
Was going to keep bringing the World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
After 10 years, Joko Widodo is wrapping up a hugely popular tenure as president, and Indonesia will have its first three-way election in 20 years. Will Indonesia continue along Jokowi's path of free and active foreign policy, or will his successor lead the country in a new direction? Keep it tuned to Bloomberg for live coverage from Jakarta and all the results and analysis you need. Indonesia Asia decides. Coverage starts Wednesday right here on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
CPI data coming up a little bit later this morning. Equity futures on the S&P just a little bit softer. We're negative here by a third of 1% on the S&P 500. Down a single basis point in the bond market, the 10-year, 416.37. Under surveillance this morning, President Biden pushing for a pause in Gaza.
As the King and I discussed today, the United States is working on a hostage deal between Israel and Hamas, which would bring an immediate and sustained period of calm to Gaza for at least 6 weeks, which we could then take the time to build something more enduring.
Here's the latest this morning. President Biden pushing for a 6-week pause in fighting between Israel and Hamas. The president speaking alongside King Abdullah of Jordan. The meeting coming amid growing concern about a potential Israeli ground offensive in the city of Rafah, where over 1 million Palestinians have fled since the war broke out. King Abdullah calling for an end to the war, saying this: "We cannot afford an Israeli attack on Rafah. It is certain to produce another humanitarian catastrophe. We need a lasting ceasefire. We need one right now." Joining us now is Norman Rule, former U.S. intelligence official and a member of the CSIS Transnational Threats Project. Norman, can we just take a step back and think about the original objective of the Israeli military, which was to destroy Hamas? How much progress have they made in the last several months?
Good morning. Without diminishing the significant humanitarian catastrophe of Gaza, Israel has achieved significant success against Hamas. In essence, Hamas had 5 brigades arrayed from north to south. 2 in the north have been destroyed. 2 in the center have been significantly degraded and are in the process of being destroyed. And the final brigade is located in Rafah. But as they have moved south, the nature of the battle itself has changed because of the concentration of civilians, which is why the United States was pushing for a less intense conflict and more hyper-focused surgical operations against the remaining Hamas leadership and fighters.
Norman, how does Israel go into Rafah to get rid of the remainder of Hamas and at the same time make sure that they are credibly making sure that they are protecting Palestinian civilians?
Well, they only have 2 choices. First, they undertake a very long campaign to degrade both the Hamas remaining brigade, but also to go against the tunnels under Rafah. And these are extremely deep, and this is where the fighters are hiding. This would be a very long and costly battle while the civilians are suffering. The alternative is to move the civilians out. The problem is there's not many places to go. They could go to El Mawassa, about 6 miles away, too small. They could send them north again, not a lot of facilities for them in that area. They could move some into Khan Yunis, where fighting remains, where they can work around them. It's very complicated.
You have the head of Mossad today meeting with CIA Director Bill Burns. If they are able to move ahead with a hostage agreement, would that mean that Israel would then not go into Rafah?
Well, Israel would say that a hostage agreement would delay going into Rafah. Hamas will push for a very lengthy hostage agreement that in essence would allow them to survive and declare victory through survival. If you're Hamas, survival means victory and then dominating the post-war environment and in essence restoring Hamas's domination of Gaza and perhaps the West Bank.
Norman, how much are you concerned about Netanyahu, the Prime Minister of Israel, and how much the news reports seem to suggest he's going it alone and kind of defying a lot of Biden and what he's saying? Does that give you pause?
Well, it's a concern, but I think Prime Minister Netanyahu also does reflect a genuine belief in Israel that they cannot sustain another situation where Hamas might return and repeat what it did on October 7th. So it's fair to say that Prime Minister Netanyahu reflects a hard line of the right wing, but it would be unfair to say that he's the only person that believes that Hamas must be destroyed, that a new situation in Gaza must develop, and that a 2-state solution should not be rushed into because that might just mean a Hamas-dominated entity on the Israeli border.
Norm, I have to say, there are senators in the pajamas right now voting on this bill, trying to get aid to Ukraine and to Israel passed. It's dead in the water because the House isn't going to bring it. And you have Elon Musk talking to U.S. Republican senators yesterday saying there's no way in hell that Russian President Vladimir Putin could lose this war in Ukraine. We got to kill this thing. That is Vance, where we're talking about the potential bill. What do you make of that? How concerning is that?
It's concerning. In essence, it may be politically popular to deny aid to either party, but in the end of the day, providing precision-guided munitions and strong intelligence protects civilians and enables those partners that we support to win or sustain their defense. It's as simple as that. If you deny them precision-guided munitions and intelligence, you lengthen the fight, increase civilian casualties, and you certainly don't necessarily undermine their will to fight.
Norman, let's talk about U.S. rhetoric and U.S. policy. U.S. rhetoric is shifting. Private meetings reportedly suggesting the president, Joe Biden, is calling the Israeli leader an a-hole 3 times separately. That's a shift in rhetoric and maybe a convenient leak from this White House. Norman, have you seen a change in policy in any way, shape or form?
Practically no at present. The U.S. aid continues to flow forward. The cooperation on hostages continues to be strong, but the U.S. is appropriately concerned over how the Rafah campaign will go. There is nowhere to move this population. If Israel conducts a traditional campaign in the south, the civilian casualties would be enormous with catastrophic humanitarian consequences, but also huge political consequences in the United States and obviously a domestic political component as well. I don't think Israel intends to do that, but nonetheless, I think the concern in the White House is indeed genuine.
Norman, sometimes it's quiet with regards to regional actors, and I'm thinking specifically of Saudi Arabia. What are you anticipating is going to happen with them in the coming months, coming quarters, towards the end of the year? Are you expecting a shift in their approach to this situation?
I do not. The Saudis are going to consistently call for a ceasefire, a 2-state solution with a definite time frame for when that solution must come about, and a situation where the humanitarian aspect of Gaza is resolved. There is enormous sensitivity in the Arab world to what they see as the daily drumbeat of the death of Palestinian men, women, and children. We don't have that same drumbeat in the West, and the Saudis aren't going to shift.
Norman Rule, thank you, Norman. It's got to catch up. Former senior U.S. intelligence official as the President of the United States pushes for a 6-week pause. Can we talk about angry Biden and how convenient some of those leaks might be? Do you think that is more about him being questioned about his mental acuity, how focused he is on the job at the moment, that ultimately they want to see him as being focused and angry, passionate behind the scenes?
Well, Biden is very well known to have a temper. This has been documented to his time when he was vice president. But these leaks are coming from individuals in the room, according to this NBC report, who were at donor meetings. And Karine Jean-Pierre was asked about this yesterday, and she said she's not going to talk about or elaborate in the president's private conversations. But clearly, there is a lot of frustration in the White House, but also within the campaign. You see an outreach from this administration to go to places like Michigan, where there's groups saying, quote, abandon Biden, that voted for him in 2020, Muslim Americans, and feel like he's turned their back on him.
As Norman said, it's a change in rhetoric, but not a change in policy. Coming up on this program, the demand for AI helping chip designer ARM to nearly double in 3 days. That conversation is coming up next, live from New York City. This is Bloomberg.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City, CPI report about 2 hours away. Coming into it, the scores look like this on the S&P 500. Negative here by a third of 1%. On the Nasdaq, down by 0.6. Pulling back just a touch yesterday on the S&P, snapping a 4-day winning streak after 5 weeks of gains. The last time we had a weekly loss was the first week of this year, and then you've got to go all the way back to the end of October. That's how good things have been over the last 3 months or so. Your equity market then pulling back. The bond market looks like this. A 2-year, 10-year, 30-year shaping up as follows. The 10-year yield down by 2 basis points, 4.1618. The 2-year down almost a single basis point at 4.4677. Quick look at the euro. Was negative yesterday, just a little bit lower, and it's bouncing back today. 107.81. We're positive on that currency pair by 0.1%. Under surveillance this morning, US CPI data on deck 2 hours from now. Bloomberg survey forecasting an annual read of 2.9%. This would be the first read below 3% since March of 2021. Bloomberg Economics also expecting housing, rents and core services to overtake core goods as the driver of disinflation. This conversation picked up around this table, I think, in the last week or so when we heard from Mr. Barkin of the Richmond Fed, and he talked about the B word, Lisa. We need to see this broaden out.
I'm hopeful, but still looking for more conviction of the slowing inflation, that it is broadening and sustainable. Those were his words. How much do you end up seeing this in that data? What people are saying, it suggests that we will. If you don't, is that going to be enough to keep the Fed on hold? If we do see it broaden out materially, but the headline number doesn't shift, is that enough for them to cut in March? Is that where our conversation and our threshold is going?
And does this have the potential to tip us into maybe a less favorable market regime to those of you that are constructive on equity markets? I'll go back to that quote from Stuart Kaiser of Citi yesterday around this table. This print, quote, has the power to toggle the storyline between soft landing and overheating.
What I find interesting is after he came on our show and after he put out that report, Citigroup analysts came out and warned of a possible 1998 situation where the Fed does cut rates a couple times, but then is forced to raise them again in a year or 2 years when inflation heats up again. How much is Stu talking about exactly that type of environment where basically it's just, you don't kill the beast, it kind of lingers there, and you end up in a very different regime than zero rates that we had for so many years?
Without a doubt, that's the scenario that some of these Fed officials are clearly fearing. Want to keep one eye on this down in Washington, D.C. The U.S. Senate voting right now in order to pass a standalone aid package for Ukraine and Israel. Leadership on both sides of the aisle confident that $95 billion will pass today. Speaker Mike Johnson warning it will face opposition in the House without a deal on U.S. border security, saying, quote, the House will have to continue to work on its own, will on these important matters. AMH, this one's going to fail in the House, right?
Yes, it's absolutely going to fail in the House at the moment. Speaker Johnson already throwing cold water on it. Before the Senate even went to the floor this morning, that vote started at 5:15 a.m. to take up this bill. He threw cold water on it and said it's pretty much dead on arrival. Yet again, he said this in the House. I'm looking at the vote count now. Senator Cassidy, wake up if you're not there, apparently has not voted. According to C-SPAN, it's 69-29. So we're missing 2 senators to vote, but they have the votes for this to go through. But again, it doesn't matter if it passes the Senate because it's not going to pass the House.
So we shouldn't be talking about it, basically?
Well, we're going to have to keep talking about it because at some point, potentially, there could be different avenues or paths forwards for some of this aid. We do know there's a lot of bipartisan support overall for a lot of these programs. It's just potentially how it gets done. Do we potentially decouple them? And is it a separate Israel package, a separate Ukraine package, a separate Taiwan package?
What do you have if you have like the likes of J.D. Vance of Ohio saying things like, we got to kill this thing? And basically Elon Musk saying that Vladimir Putin can't lose. What does that say to our basically allies out there, let alone internally? It just raises this question, regardless of the politics of the theater, a question of alliances, a question of just conviction that the U.S. is going to be there in the same kind of way.
Why do we give people who are successful in a very narrow field a voice on everything, on literally everything? So if you become highly successful in technology or whatever that business line might be, why do we as journalists, and I say we because it's an institutional approach to the news, why do we give them so much oxygen to basically pontificate on everything under the sun?
Okay, fair point. However, Elon Musk was also talking to U.S. Republican Congress members.
No, in this situation.
But I agree with you. I agree with you that in some ways the business leaders have become ambassadors, in part because a lot of politicians haven't been as much and that aren't necessarily representing the business world in the same kind of way as they have traditionally.
Also, if Elon Musk was around this table, he would tell you he's done more for Ukraine than almost Europe or the United States, given what he's done with Starlink and the internet connection in Ukraine. But to your point, Jonathan, he has his own social media platform. He decided to corral a bunch of Republicans who are against this bill and siding with him, and we wrote it up.
That's the latest on Washington. Chip designer ARM soaring on Monday, tripling since its IPO last September, and nearly doubling in 3 days. The AI boom also happening in video, which briefly overtook the market value of Amazon during yesterday's trading before settling just shy of a value of $1.79 trillion. Investors going all in on U.S. tech stocks. A global survey by Bank of America saying allocation to tech is now the highest since August of 2020. Bloomberg's Alex Webb joins us now for more. Alex, would you describe this as an AI frenzy, given what's happening in names like ARM at the moment?
Yeah, I mean, it certainly looks that way, particularly with ARM. I think when ARM first came public, it had been trying to convince the market that, you know, it's an AI stock, and there was a certain amount of skepticism about whether that was really the case. It didn't really look as though it was delivering much value at that stage when it came to AI. It seems now that the market is buying that message, certainly given some of the statements made last week. It doesn't have necessarily this kind of direct exposure that NVIDIA might have, but a lot of its chipset designs essentially are used to kind of underpin a lot of the specialist chips that are produced by the likes of NVIDIA.
Alex, you have the really unwanted job probably, or maybe wanted by some, of trying to label what's real and what's fake, what's sort of overhyped and what actually has legs. Is the mere suggestion of an AI boost to sales enough to justify the rally that we've seen in the ARM shares?
I'd love to pick, you know, the sort of investor relations and CFO and finance team of ARM's brain right now, because of course they want to get the recognition for what they're doing in AI. They don't want to have it over-egged, because if the expectations are set too high, the risk is that you set yourself up for a bit of a fall if there's any sign of disappointment in the quarters to come. If you're an investor, clearly you're not upset if the stock's going high. But I've spoken to other companies who, you know, not ARM, but I've spoken to other companies who express this sort of sentiment, that yes, they want to be recognized for what they're doing, they don't want it to be overcooked. If you look at NVIDIA, it's pretty interesting. Like, it's trading at about 35 times its forward earnings. That isn't wildly outside the realms of what some of its peers are doing. The risk is with ARM is actually it starts to get a little bit out of that space. Maybe they can deliver. It is not for me to predict that, but that would be the concern.
Can we officially say that Tesla is out as we see some of these shares surge? And Tesla, I think year to date, is down some 24%.
In terms of AI, I mean,
yes.
You know, it's fascinating when you come look at Tesla, because Elon Musk is trying to make the case that, you know, they're an AI company, and clearly they have a lot of tech at that company. But, you know, I've followed this self-driving space for quite some time, and you never really heard about Tesla being really right up there in the top tier of self-driving technologies. When you think about Waymo, you think about GM's Cruise unit, which has some other investors in it as well. Aurora, those guys really thought of as the top tier. Tesla, not often thought of in the same category. So I'm not sure. Maybe the market is, you know, waking up to that now. Full self-driving, is not full self-driving, right? What they brand as full self-driving does not let you go out on the roads with your hands off the steering wheel for an extended spell. So it seems as though that message might now be trickling through, and of course, it only really scales within Tesla, doesn't necessarily scale outside of that.
Alex, the reason why I ask is because when you zoom out, there's a real question of when the AI boom and craze will sort of trickle out to other companies that are going to use it to create operational efficiencies. This is something that increasingly investors are looking at. Can we see the same kind of boost to equity valuations, the same kind of boost to earnings for other companies outside the traditional tech sphere already coming to the fore? I mean, are people sniffing that out already, or is that still kind of a yet to be discovered space?
In honesty, I don't know, is the answer to that question. There might be companies actually that are going to be very well positioned and will wake up to that in a few years' time. There is a lot of, if you think about some of these big consultancy firms, for instance, they really like to talk about the potential, the likes of Accenture and Ernst & Young, BCG, McKinsey, all those guys, they really like to talk about the potential of AI on two fronts, right? It can do some of the work that actually they have sort of junior consultants doing right now, and also then they can bring those capabilities into, AI field capabilities into their clients' firms. Does that mean that they are an AI play? I wouldn't say so. And in fact, Accenture's, I think, the only one that's actually publicly traded, so it's not a great opportunity for investors in that sense. This is still so early, right? This is still so early in the AI revolution, evolution. I think evolution might be more appropriate as a word, because the thing we're seeing right now is relatively broad brush stuff, where you see huge applications, the likes of ChatGPT. Increasingly, you're going to get hyper-specialized applications of AI, and that's where the real opportunities are going to explode. We don't really know who those companies are yet.
Alex, good to hear from you. Alex Webber, Bloomberg, out of London. Just a quick sneak peek of what's happening in the pre-market with ARM at the moment. After almost doubling in 3 sessions, we're negative here by 2.56% in the pre-market on ARM Holdings. We've been talking about that $95 billion bill going through the Senate right now. Senators up early to pass a $95 billion aid bill for Ukraine, Israel, and Taiwan. This is the Senate. Ultimately, AMH, as you said all morning, this is not going to get through the House.
Major hurdles to get through the House of Representatives, and you see Senator Chuck Schumer there talking to a very early morning group of senators voting on this. It came in 70 to 29. There was a number of Republicans that were in favor of this, bucking against some of the trends we have seen from some of those other Republicans who are following in the former president Donald Trump's lead at the moment, talking about a more isolationist approach. But you have to think, before these senators even woke up and voted on this final passage, they were met with a statement from Speaker Johnson basically saying the House is going to go in its own way.
Do you want to take that live shot again? What did you notice about Senate Majority Leader Chuck Schumer? Suit, tie, ready to go.
I have an update, though, on what they're wearing, though. Steve Dennis told me Senator Britt appeared to be heading to the gym next. Senator Fetterman, trademark hoodie and shorts. Chuck Grassley, farmer casuals, and Ted Cruz wearing a Longhorns sweatshirt.
Great that they're going to go work out. Be healthy. Live long.
Go get them. Okay, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Biden is forming a task force to address the mishandling of classified documents during presidential transitions. A special counsel report had found that Biden kept documents in his possession after he was vice president. White House officials called it a systematic issue affecting both parties. The task force will provide recommendations before the next presidential transition. The International Energy Agency expects global oil markets to remain comfortable this year. New supplies will satisfy demand and keep prices in check.
In the absence of major geopolitical turmoil or major extreme weather events, we would expect rather a comfortable oil market and comfortable moderate price evolution throughout 2024.
The IEA says world consumption will increase by up to 1.3 million barrels a day, a significantly weaker pace than last year. Tiger Woods is launching a new brand after ending his long-term endorsement deal with Nike. The golfer signed a deal with TaylorMade Golf. Together, they'll create an apparel line called Sunday Red. It's set to debut in May. Financial terms for the deal haven't been disclosed. That's your Bloomberg Brief. John.
Danny, thanks for that. Coming up on the program, up next, inflation data on deck.
I think at some point it will be appropriate for us to lower the federal funds rate. I don't see that in the immediate future, and I don't want to prejudge what our decisions might be going forward this year.
That inflation data about 2 hours away. The scores in financial markets shaping up as follows. On the S&P 500, negative here by 0.4%. In the bond market, yields lower a single basis point, 416.57. Live from New York City, this is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Stocks slightly down yesterday, just a little bit negative this morning. Same game. We're down about 0.4% on the S&P. We're down a basis point or two on a 10-year, 416.37. Euro not doing much. Trading water going into that CPI data later this morning, 107.74 on the euro. And crude, it's the smallest of bounces, 77.42 on WTI. Under surveillance this morning, inflation data on deck.
I think the progress that we're making on inflation is very positive. And as long as we have continued progress at the current policy rate, I think at some point it will be appropriate for us to lower the federal funds rate. I don't see that in the immediate future, and I don't want to prejudge what our decisions might be going forward this year.
Here's the latest this morning. Fed officials reiterating it's too soon to ease policy, with January CPI data dropping in just under 2 hours. The median estimate in our survey calling for the headline number to drop below 3% for the first time in nearly 3 years. Jennifer Lee of BMO writing, quote, policymakers and markets will need to wade through some mixed messages between the headline and core rates, but would likely conclude that more evidence is going to be required for the Fed to feel comfortable with the plan to start easing mid-year. Jennifer Lee joins us now for more. Jennifer, wonderful to hear from you. Let's just start with the evidence that these disinflationary trends are broadening out. How much evidence do you see?
Good morning, and thank you very much for having me on the show. I mean, we are seeing some evidence of this broadening out, but it's not as broad, I think, for what the Fed wants to see. You know, this is where the whole sticky, and this is the S word again, the sticky inflation story is still playing out very broadly. And this is like a story around the world as well, which is why we're not seeing central banks cutting more broadly already. Here we are in the first quarter still. But, you know, so I think they want to see, again, more evidence of that playing out and being more comfortable, as Governor Bowman said yesterday, before they can start feeling better about and more confident about cutting rates.
Jennifer, when you zoom out, there's really this existential question: will the Fed have the conviction and the ability to kill the inflation beast? Will they end up maybe staying on hold, cutting a few times, but facing a resurgent inflation later this year or next year that causes them to have to hike rates again? We heard from Citigroup's Jason Williams over the past couple of days, where he wrote, the market should price in some risk of future hikes. Look to 1998. This cycle could be more akin to the 1998 easing cycle, which was short-lived and led to more rate hikes. Do you agree with that?
That would be, I think, a big problem if they cut a couple times and then be forced to raise rates again. And I think this is where you could see a big credibility issue being playing out at that point. So this is what the Fed totally wants to avoid, and this is why they are so hesitant right now to cut rates too early. We had the market completely pricing out at one point late last year, like almost 100% chance of a rate cut in March, and then thankfully, Fed Chair Powell came out last week or 2 weeks ago and basically dismissed that whole idea almost completely. So again, they're just trying to tell everyone to be patient, chill out, sit back, and let's just watch the data and make sure we are confident. And there's all those keywords that they keep throwing out: confidence and patience, and that inflation is heading toward that 2% target on a sustained basis. This is what they totally want to see, and I don't think just a few numbers are going to cut it.
So the B word, broadening out, the C word, confidence. How much are you getting the sense that specific components are coming down when it comes to inflation enough to be sustainable over the long term? In other words, do you believe that this is a